also.
Yeah.
And what's your consultation? Because I'm doing a 725 the research method.
Yeah.
I'm doing the topic about the exchange rate and the hedge method. I want you advice.
Okay. How's the unit going?
Good.
Good with VJ, is it?
Yeah.
Yeah.
Yes.
So you get some of the finance people coming in. So. Oh, that's so good. How'd you get? You must have done well in your other units, have you?
Sorry?
Have you done well in your other units to get into that unit? Have your results been quite good?
So.
Okay, right. Okay, well, it's a good unit to do. Okay. Look, this afternoon, except I've got a meeting, but I can be called out of the meeting. And tomorrow.
Yeah, what time?
I've got meetings. I got a class at 3, so plus 1:30 or something.
3:30?
No, 1:30.
1:30.
Yeah, what I've got. They lock me into meetings in the morning.
Yeah.
But are you here another day?
Yeah. Every day.
Every day.
Yeah.
Okay. Well, maybe on Wednesday. How about Wednesday afternoon?
Yeah.
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 I think I'll be available from 2 o'clock.
2 o'clock.
Yeah. So if you just email me.
Okay. Yeah.
Okay.
Yeah.
Just email me directly.
Okay.
And just say who you were. So your name is.
Yong Tao.
Yong Tao. Okay. So you email me and say spoke to me about 2 o'clock on Wednesday. So that just reminds me. I'll put it in my calendar because other people arrange for me to do things and they don't tell me. They'll have to be there, right?
Yeah.
So that's fine. Yeah.
Okay.
I'll see you then.
Yeah. I will email you tonight.
Yeah. That's right. Just to remind me, I get in my diary.
Okay. Thank you.
All right. Okay, everyone hear me all right? Yes? All right. Okay, so I'm going to do a variety of things tonight. Okay, tonight really puts up a fair bit of background to assist you with your assignment. And in fact, if you can understand quite well these next 3 weeks, then you should be able to score very well in an exam. Okay? Because there's generally significant weighting to it. Okay, most of the stuff that I do tonight and tomorrow, and the previous couple of weeks are quite new. Okay, you won't find this stuff in any textbooks. Okay, it's a methodology. The tools I explain differently so that it's easy to understand. Okay, so this is on an I lecture. So what I'm doing is I'm firstly just going to cover the assignment. I notice that most of the things I've been doing on DSO has been taking students out of groups, okay, etc. You may have noticed that. Also, I have two tutors, okay, who have now got their past works organised, so I'll be contacting them tomorrow, and they can access DSO, and they will be, in particular, that they will be answering your questions under the topics. Okay, so I am employing them because I've been seconded to work with the Dean for at least 1 day a week. Okay, so they're going to be in there to answer questions. They're quite experienced. They're former students of mine. They've been involved in this unit for some time. Okay, so they're happy to answer their questions. They both, for their age, have relatively responsible jobs in finance. Okay, one comes from Kenya and the other one comes from Zimbabwe. Okay, so we are very much a multicultural unit. Okay, all right, so your assignment, okay, should be 4 members. I'm not going to be too fussed if it's 3, but it shouldn't be 5 and it shouldn't be 2. Okay, as I said to you before, okay, it's an attribute here that you can work with other people. So that's why I do it, and we have to assure our learning in that respect, your learning. Okay, I've got words 1,500 to 2,500, but you don't have to count up the words because it's how you present data. You need to. The most of the work is in thinking. Okay. Once you've organised your data and so on, it's just an explanation of that. Okay. So, but for faculty reasons, I have to put how many words it is. Okay. But I'd imagine that it would be 10 or 12 pages, something like that. But you'll need to manipulate some data, so you need to incorporate tables, and that becomes quite important that you can, I'm asking you to think down and how do you present the material. This is the type of work a finance consultant would do, okay? So it's worth 20% of your assessment. It's a business report. You don't have to write an executive summary. It's effectively 5 projects that a company would ask you to do. Okay, it's 5 projects. Project 1, just answer. You can put a cover letter or whatever, but it's not required, okay? In a business sense, there probably would be a great big long report, but that will be okay, okay? Remember that actually issues regards plagiarism and so on, if you're at this stage of your course, you're quite familiar with that, but essentially you're going to have to analyse what you create yourself, so you can't really plagiarise it, if you know what I mean, right? I mean, you're the only person with, or your group's the only one with that information, okay? So you need to do that, okay? All right, so I've got the date there, which is a Friday. And I've got the DSO, right? 11:59 p.m. Okay, so that's for off-campus and on-campus. So on-campus, off-campus students put their assignments in a hard copy I get eventually, but I sometimes mark them off the online because it might take 10 days to get to me. On-campus students, well, obviously it should be uploaded by 11:59 on Friday, but I'm not going to be here then. So I prefer if you handed in a hard copy before that. Okay, so if I get a hard copy by 5 o'clock on the Friday, I can immediately put it to the assessors. Okay, if I have to wait, it puts us back a bit of time because my assessors don't. They're not waiting. They don't generally have the time during the day. Okay, and I'm one of the assessors as well, even though I supposedly do have that time. Okay, so whether it meets the time requirement, it needs to be up on DSO. okay? But I'd like a hard copy as well, okay? So, and because I have, this assignment is relatively complex and I need to assess it with a hard copy, okay? All right. Okay, so these are the things I'm looking for. There's a Deakin student about knowledge, skills and particular attributes. So I want to advance your knowledge in the hedging area. You're challenged to plan and think. When I was an undergraduate student, tutor told me that all you come to university for is to learn how to think. That's all it is. Okay? All right. Source relevant information. Okay, this is finding out. This, synthesize data, information. Synthesis is what is on what we call a taxonomy of learning, is at the highest level. Okay, synthesis, very valuable skill. Okay, identify data, for instance, use it, collaborate with others, improve your problem-solving skills. Okay. Okay, the first question is about a company who is an importer, and they've obviously got foreign currency risk, and explains how much risk there is, and they've done particular strategies recently, and what they're asking you to do is to go back through past data, okay, and analyse as to whether their hedging strategy was good or not. Okay, so they've, I think, I can't remember everything, maybe they've just done the spot market, whatever, but you have to go back and find the exchange rate on a particular date, calculate the forward, calculate the option, whatever it is, okay, and you need to compare the different, so using past information to give us a feel for what we should do in the future, okay? But you also have to think as what's happened to the Australian dollar in that recent time, okay? So there's a number of assumptions in there as well, okay? So if anyone notices a typo, because my work really doesn't get proofread by anyone else, so I'm happy to change things if I need to. I think that looks all right, yep. Okay, so you can get the data from Oz4X. Many of you have visited that site, and you can use the FX pricer, and I'll do a demonstration of that tonight. Those of you who have been up on DSO would have seen the pricer up there as well. It's really just a straight spreadsheet, okay? Relevant interest rates from ... Okay, all right, I'll get that for you. I just couldn't remember the exact website. I thought, well, I'll do it. So it's at the Reserve Bank of Australia anyway. You can get the interest rates. Methods. Okay, so these are the ways. They're just using a spot rate, using a forward, using a current, an option, range forward, any alternative, and summary of results. Okay, so it's really about what I do in these next 3 lectures. Okay. One, you could do the first. You could actually set it up now with the spot rate, and do the forwards. You know. Okay, the second one is about a company here. Okay, so they're dealing with what are they doing? Selling machines. Okay, they're selling machines to China. Okay, and they're getting paid from China. Chinese yuan. Okay, and there's no forward market. Okay. How do you deal with it? Okay, so again, I'll explain a technique which has become very popular over the next, probably next week, and as a hint, that helps you do it. Okay, all right. Number 3. Okay, this is a question on currency options, and if you the answer is really in the slides. Okay, and you should be able to answer that. I really want to make you an effort. Want to really get you familiar with these option tools, okay? And I think that students have found this quite challenging and very interesting, okay, in the past. Okay, well, have we got another one? Okay, so this is a weather one. Okay, I do weather in week 7, okay? Show you how to hedge the weather, change the weather, okay? All right. It's weird stuff. I'll tell you what, you won't believe it when I show you this stuff, but you will never forget it. because it's so weird. Okay? How could you manage the weather risk? Okay. Bit hard in this country at the moment, but you'll see. Okay. Okay, so there's 4 questions. Sometimes it was worth 30% more, so I'll just round this on back a little bit. And the last question requires you to explain, because it's within the university attributes. And so what I'm asking you here is to explain how your group worked, when they met, what people did, when you came together, how you organised the work program, things like this. In fact, when you go for a job, it's one of the things. They ask you, can you work with other people? And you can pull this out and say, we got 4 out of 4 for this group. This is how we explain what we did. I mean, it's crucially important, okay, within the workplace, okay? So there's some challenge. So there we are, okay? So I'll go through all the materials, okay, and it will be more than enough to be able to do that. I told you that last year, here we go. Pardon? I like it to be 3, okay? Not with like your best friend, okay? And you can mix, you can be in the Tuesday class. You could even go with off-campus students. A large percentage of off-campus students live within 10 kilometres of this lecture theatre. Half of them do. Right? They all live in Melbourne, okay? Some of them are not. There's a couple in Vietnam, there's one in Laos, I notice. There's one in the United Kingdom, I know. So they're spread throughout the world, okay? But time zone's not too bad, actually, because you can send an email and you get a response the next day, you know, or you wake up in the morning and you get a response. I find that to be quite good, actually. All right. Okay, so last week, I got a bit distracted, I think, last week, okay? So I did. Okay, so you'll notice that these slides I showed you on this harmonic trading, I put them up on DSO because I didn't. I put just the 3 slides up there. Okay, so for those of you interested, I've been approached for students who are really interested in this technical trading, and hopefully with Michael De Rosario we might do a few sessions for those who are interested, not for a month or so, about what happens here, but this is the focus of my research at the moment, and it has a pecuniary benefit as well. So I'm more or less reading everything there is on this methodology, and yeah, it's you know, you heard me mention about Fibonacci. You see this thing here, that's 100, and 61.8. That's a really key number, and the Fibonacci just works in life. So what they're arguing here is that the financial markets reflect life. Okay, Fibonacci numbers are used to build the pyramids, for example. So it's been around for a long time. It's just been, because it's mathematical, if you like, because these relationships between this here and up to that point there is 0.618, okay? So that point there is 0.618 of that distance there, okay? So they've all got particular relationship to these numbers, okay? And the research that indicates to me is if you've got this data, it's got a 70% probability of being successful. So let's go 60%. That's very high. In fact, as I walked over here, I've been on my telephone to one of my students, and we collaborate on a trading methodology, and his options knowledge is very good, and I've just told him to check the email I sent him last night and look at these videos, okay, because if we can use that with the option strategy, it makes it very powerful, right? So that's up there, okay? All right, and it's linked into the electronic trading, okay? Okay, so last week I didn't do this. Okay, the determinants. Okay, so I did the technical work last week, and this is more the fundamental. And there's no doubt. Well, just before I start that, now it's an interesting thing that actually I thought about on the weekend. And the view that when you look at financial markets, and I can say to you that price changes, doesn't it? Price changes all the time. Okay. So I'm saying, well, these markets are volatile because the price changes. Okay. Okay. But what's come home to me is the price only changes because of human behaviour, right? Now, if there's no buyer or seller, the price stays the same. So price, rather than price changing, human activity, buying and selling, changes the price. The price doesn't change of itself. I guess we all know that, really. But when someone says it to you, that really it's responding to human behaviour, right? If there's a lot of buyers, price goes up, okay, in relatively perfect markets, okay? And they've got to find people who want to sell, okay? So, interesting. Okay. All right, now exchange rates. All right, they are influenced by all these things here, okay? And in a fundamental sense, yes, exchange rates, are influenced by these things, okay? And these ones are unpredictable, okay? A country which has high inflation rates, their currency would depreciate. Any examples of that? High inflation rate, currency plummets. Zimbabwe? Pardon? Zimbabwe? What are other ones? Pardon? Greece. Well, Greece is in with the euro, so the euro has, Greece is part of the eurozone, okay? And of course, their problems in Greece were major, and that did cause the euro to drop. Yeah, for sure. But if the previous Greek currency is called a drachma, right? I mean, if that had happened when they had the drachma, it would have been worse, right? Because it's just Greece. Okay. The other country I mentioned last week in the 1990s was Russia. Okay, Russia. 30% a month. I mean, your currency disappears when you put it in your pocket. Okay. Right, the other one is purchasing power, and that's also, so it's relative, it's comparisons with other countries. All right, also, if you're purchasing power parity, which is really your own individual currency, what you can buy with the drops, purchasing power parity means that you can't buy as much as you could before. Okay, so your currency's like to weaken. The other one is just countries' national income growth. Successful economies, their currencies generally appreciate. Okay. Tariffs and quotas impact, they just add a price. Not so common nowadays. There are some quotas here within Australia. The tariffs are quite minimal nowadays, very open economy, but many countries control what can be imported and exported through other means. Okay, one of my colleagues, a professor here in my school, Professor Charles Corrado, who is very good in investments, he says that you needn't worry about any of that. It's all to do with interest rates. Okay, but yes, okay. So interest rates have a big impact. Okay, and if you've seen a question put on DSO yesterday, I think a student says, let's see what happens when the next RBA meeting is. Because the RBA meets probably in 2 weeks, and they'll have another interest rate announcement. One would expect, I'll guarantee, I reckon I could guarantee this, that if they increase the Australian interest rate by 25 basis points, exchange rate will go up. Okay? I think I'm 90% sure that would happen. You want to tell me why I'm so sure that would happen?
It increases the risk-free rate return that you can actually get. So I suppose, as you said, with purchasing parity kind of cancel out the benefit of arbitrage.
Yeah. I mean, certainly that's the principal reason, but there's why can I be so sure though? That will be the consequence. What you say? Pardon? Yeah, it's going up at the moment, so it's going to keep going. All right, yeah. Pardon?
Carry trade.
Yeah, carry trade. I mean, the carry trade responds to the difference, but it'll make it more pronounced. Therefore, it was more likely to take place. Yep, that's good. Yes, yeah. Okay, well, you might think I'm wrong, right? The thing is that my view is, the market's view, I think, is that the interest rates won't go up. Okay? So the expectations, I would think, is that the Reserve Bank will not increase the interest rate in 2 weeks. Okay, you can hold me to that. Right? So, if they did, it's unexpected. Okay? So when I talk about expectations, so I would think that there might even be a bias because employment hasn't really increased in Australia. You've got this issue with Japan, major trading country. So you've got all those issues. So the thing is that if we look at the equality, I would think that they probably would not increase the interest rates. Then if they do, it's unexpected, so everyone exchange rate will go up. Okay? Because, okay? So anyway, before they announce it, there'll be a view from the market, and I'll give a probability to it. Okay, but my view it'll be only 20%. In fact, it could even go down, perhaps. Okay, so just think there's expectations there. What your answers are consequences of what will happen when it goes up. Yep. Or perhaps they're getting ready for it. Okay, so that's the market. Okay, central banks might intervene. Central banks that are active interveners is the Bank of Tokyo. Is active in intervention, okay, more so than the other developed economies. More so than the euro, Aussie dollar, pound, and that. So the yen is the one that gets into it a bit. And obviously, the news and the media. And I mentioned last week about the Plaza Accord. Okay, so these are news items that come out. If you go to forexfactory.com. Anyone been to forexfactory.com? Anyone? No. Must be doing something wrong. Okay. All right. So these things would come off Forex Factory, right? And Forex Factory will put a red star next to it or some other colour, and they'll say whether they think it's important or not. Okay. Okay. So New Zealand current account. What a New Zealand small economy, don't worry about them. Okay. Bank of England chairman speaks on retail sales, big indicator of their performance, their economy. Might move the market. US new home sales, a whole lot of houses for sale in the US. And to increase new homes, the economy must be starting to jump, I would think. Okay, this guy Bernanke, right, that will be a red star. I'll wait to see what he says. Okay? If you read what he says, it's very hard to interpret what he really means. Okay? That's what they don't want the market to assume that he's going to do something, but he has to say something. And as I mentioned, the big market mover is non-farm payroll, and I'll check Forex Factory myself. If anyone happens to check it and see it's this Friday, let me know, please. Okay? But it won't be up there yet because I don't think it's for another 2 weeks. But anyway, when it comes up, and we'll just see what happens. Okay, so there's a couple of questions up there on DSO I put that came out of the lecture last week, and I see that I've got all 300 students. I've got one response. Okay, so you could argue that the interest rate parity, which is used to calculate the forward, is an unbiased estimator of the future rate. Okay. And it could be the future rate, but not necessarily. But it's the most unbiased. There's no expectations in it, just a calculation. Okay. So a lot of articles are written about this, okay, and they would argue that trying to predict the exchange rates are an absolute waste of time, okay. I don't quite subscribe to that, but to say that it's difficult to do, okay. Okay, I'll move on, okay. As the academics I mentioned, the research and academics say that you cannot do it, but I think there are people who can, okay. It's very hard to collect the data on who's successful at doing it, okay. Traders that work for Goldman Sachs are very successful at doing it, okay. Okay, and obviously there are firms that provide forecasts for a price. You know, they market it to companies, and companies might use them, and primarily, I guess it's a backup support to what they're doing, but it's pretty difficult to assess how good they are at doing it, okay. Okay, and those were the fundamentalists would look at these: GDP, current account, prospects for the economy, and therefore the currency might move up over time. You know, this Australian dollar is going up because we've got all these resources that everyone else wants. Okay, that China, which has got 10% growth a year, wants our resources. So that's the major reason. Okay. Okay, and they've got an interesting index here. Okay, we call it the CRB. That stands for Commodities Research Bureau. Okay, so this is an index like any other index. You're familiar with indexes, I'm sure. So it's an index which includes the major commodities produced around the world. So it's really an index of the changing commodity prices. So in that index there'll be iron ore and steel and cocoa and coffee and wheat and soya beans and orange juice, all sorts of things that are commodities. Okay. The thing is that this index has a very close correlation with the Australian dollar, US dollar. Okay, so for next week I'll go and check the actual numbers. Okay, so even though there are many products within this index that are not exported from Australia, like orange juice, soya beans, beef cattle, things like that, but this index is often used as a predictor. So I'm saying that the market thinks it's a good predictor, so it becomes a good predictor. Okay, so there'll be probably a correlation of 80% with the Australian dollar, US dollar. Interest rates also have a major impact. Okay, so here you'd say, oh, Australia's interest rate's higher than the others. Well, at this stage, because the interest rates are so low everywhere else, it's an indication here of actually good economic performance rather than poor economic performance. Countries don't like these zero interest rates. Okay, just there's no room to move. Okay, and obviously inflation. Okay, okay. This article is in Valentine. Okay, not Jutner, Valentine. Okay, so I went through the technical stuff. Good. Any questions? Went through the algorithmic trading. Okay. Okay, we did that. Okay, and those questions there are on DSO now. Okay. All right, so to get with what we're doing tonight, you'll note there's a lot of slides. Some of them I just referred to, and I'm not too fussed if we don't sort of complete all that. But you need to ask questions if you're not sure. Okay. All right. So what I'm going to do now is tonight really do the tools and techniques, make you certain and sure of these techniques. These are a couple of articles that I've put on up on DSO, which are related to hedging. Okay, there's two of them up there. Oceana is a gold producer here within Australia, and QBE is the largest insurance company within Australia. Very successful company until the cyclone hit Queensland, and they're less successful now. Okay, all right. So what's our outlook? So I'm asking you, what do you think is the outlook for those currency pairs? So if you're working for a company that has international trading, they will be looking at those pairs. Okay, and what do you think the outlook might be? Anyone prepared to have a view? Yep.
With the Australian dollar and US dollar.
Yes.
I think it was either yesterday or the day before. I think the Australian dollar hit $1.02. Was it?
That's right. Yep. Yeah.
I think the factors that are pushing up the Australian dollar, you're talking before about it being rises in commodity prices.
Yeah.
And what's keeping the US dollar down, I think, is the high levels of unemployment, not much economic activity. Those aren't really changing. So I don't see any reason why the Australian dollar will keep going up.
Yeah. Okay, Scott. I think that's good. Yeah. I think that's a good comment. The strength on the Aussie to go up, the weakness on the US dollar, so it should go up. I think you're quite right. I checked before I came to class here, and it was 1.26. Okay, so that 1.2, I think it's highest in 10 years, I think, or ever, I think, since it's been floated. So. I remember it was...
That's what they're predicting.
Yeah. So, I would think that one of the investments bank predicted 1.2, next year. Right? So interesting. Okay. So the thing is that the euro and the US dollar is both those economies really haven't been performing very well. So they both can't collapse at the same time, can they? Okay. I really, I would purely look at technical stuff with these ones because both of their economies are not very good. Right? Anyone got another view?
With the Eurozone?
Yeah.
Well, I would say that, I know optimal currency areas is a bit beyond the scope of this unit, but the Eurozone really isn't, it's too big to have one currency. Really, isn't it?
Well, it does, though.
It does, but it really shouldn't. And
all right. Well, you disagree, yes.
Well, I say that because the idea of having one currency is because people shift between. You don't have depression in Melbourne because if there was a lot of unemployment in Melbourne, people would move off to Sydney or something. But that can't really happen between, say, Portugal and Germany because you can have a recession in Portugal. Can't have all these Portuguese.
No. Why can't they move?
Because they don't speak the same language.
Okay.
They don't have the same skills. It's a different. So there's really no reason why they all share the same currency. But anyway, getting back to the
Okay. I'll take you back a step. I didn't go over. There's a slide in last week's lecture, which you probably did read, right? Which puts the 5 reasons why they did the euro, right? And one of them was to do with exactly what you're talking about, which you're arguing is a disadvantage. And that one was that it would improve mobility throughout the Eurozone. That is, the depressed area, people would move to the others because once you had a Euro passport, you could just go across the border. Okay, now, that was the idea for doing it. Okay, but in fact, the only place really where I know it worked was that many people who worked in IT did move to Ireland because they've since left Ireland, right? But they moved to Ireland because of the big incentives there for software development and things like this. And that's really the only successful of them going. And the Irish economy's collapsed, so they've all gone back to their home countries, I would assume. But I think in hindsight, there's a lot about what hasn't worked. Like the language is a barrier. Yeah, even though throughout Europe, if you travel through France, Germany, Netherlands, Denmark, and that one, everyone under 25 speaks English. Which they would hate that being the standard language of Eurozone, right? Yeah. So I think that it didn't work. The one that did work is that it gave them so that you got a financial market in Paris, and there's one in Frankfurt, and there's one in Italy. So they raised equity in those small markets. So a big thing has been that when they raise equity, they raise it in euros. So it means that they can raise it from 16 countries, can put euros. So that's been the advantage in the bonds. And financially, that's been an advantage. Having one exchange rate saves a whole lot of work and stuff. But the mobility of the population was expected to be the major one, and that's been probably a disappointment, I would say. And as the student said, Greece has a big impact, and the Germans hate it because Greece has managed their economy really poorly, and the Germans are paying for them to survive. And I think they start doing the same for Portugal soon. So one would think that the euro would probably start to weaken because there seems to be more issues there that are highlighted in the media rather than the US, it's sort of one place. So I think you'd agree with that. Like it's easy to focus on Portugal. You can't say that Chicago is going to go bad. It's your point of view. Yeah.
My comment on it was going to be that both the Germans, for instance, and the Greeks are both unhappy with the euro. And my comment was going to be whichever country sort of exits first. If the Germans said, stuff it, we're getting the Deutschmark back, then I think the euro will take a big tumble.
Yeah.
Whereas I think if, say, the Portuguese and the Italians and the Spanish and so on, if they abandoned the euro and then the euro just became sort of a German-centric currency, it become very strong.
Yes, you're right.
It makes it very difficult to predict.
Yeah. I don't think it'll... I mean, the two countries that that developed the euro were France and Germany, okay? And it was driven by a guy called Kohl, is a German guy, and the French president... Helmut Kohl and the French president...
Chirac.
No, before Chirac. What was his name? I can't remember his name at the moment. Okay, got it. Anyway, those two brought it together. It was driven by these two politicians. So they're gone now. So it might be interesting to see. I thought the Germans might pull out last year, but once Germany goes out, you're right, or France, or both of them together, then the whole thing will collapse. Yeah. Okay, so anyway, so that's not instantaneous stuff, that's sort of long-term view, okay? Pound US, okay. Well, I think this is a pretty bad economy, pound, UK, I don't know, both of them are pretty ordinary, so I don't know which one they're more technical in that regard. Okay, so these are the questions we did last week. There are answers to nearly all those questions up on DSO. And one of the students has answered them pretty succinctly, and I've responded to that. And they're just some review questions, okay? Okay, so some of the material I did last week on how to calculate the interest rate parity and stuff is a really good couple of examples on page 337. And you'll find that the Valentine this one is the second last article in the readings. It's a chapter from his book. He's a professor at University of Western Sydney. He writes pretty much, relevant material, if you know what I mean. It's a very good example rather than God example. I thought I'd change that. Okay. So it's page 337. It does the calculations I did last week. Okay. So it's quite useful. All right. Okay. All right. So I'll just go to one of these articles. Okay. Oh yeah, it must be here. Okay. Okay, so what's relevant here is the first paragraph. Okay, so what this is this the Asciona article which is on DSO. Okay, so think of this. This is a company that produces gold. Okay, and this is last year, March 29th last year. Okay, fourth largest gold producer in Australia, so probably in the top 20 in the world. Okay, Newcrest Mining is the largest. Okay, Barrick Gold is probably the second. Okay, it's a big Canadian company. The latest goal to close out its hedge book and enjoy the full upside of a strong gold price. Okay, so what there's two things that this company has to hedge. One is the price of gold, and the other one is Australian dollar US dollar exchange rate. Okay, so what's happened here is if we can assume, and if I go back to last year, it's probably the case, that if 1 ounce of gold costs $1,000 US, okay, what they do is they buy a forward on that for 12 months, and it might be $950 in the forward. So they lock themselves in. You know, the price is 1,000 today, but they're going to supply the gold in 12 months. So in 12 months' time, they work out the price back there. They use a forward. With gold, it's a little bit different, okay, but essentially they might get $950. So in a year's time, it's $950, right? Now, today's gold price, it's $1,400. So here we are. I've organised to sell my gold for $950 1 year out, and I can tell you today it's at least $1,400. So they've lost $450 because they fixed the exchange rate. Obviously they fix it because they're worried about it going down. Sorry, the gold price. They fixed the gold price. Worried about it going down. Okay. So what this Oceania did is they close out the contracts. Okay. So that means I've entered in a contract. Okay. Let's say I've entered in a contract with you. Okay. You're going to buy the gold from me in 12 months at $950. Okay. And your name is again? Budavi. Okay. Budavi's buying the gold at $950. It's a contract I have. So what I say to you, what I'll do is I want to buy that contract back. Okay? So you will, depending on what the exchange rate is, you will allow me to buy that contract back. But if the spot price is $1,200, I'm going to have to pay you $250. Okay? So I get the contract back, but I'm going to have to pay for it. Okay? So once I get the contract back, then I can do the spot transactions. Okay? So because the gold price has moved 40% probably in the last year. In fact, if Oceania, this is probably what they did, I can't remember all the details there, right? But if they've done that, if they did that last year when this article was written, then they will be better off, okay, now, okay? Because they bought the contracts back. So they undid the hedge. But you have to pay the difference. I would have to pay you the difference, otherwise you're not going to do it. You're happy with $950, you know, because you have to go into the spot market now and buy it for $1,200, so you're asking them to pay the difference. Makes sense, doesn't it? You don't want to lose money, do you? No. Okay. All right. That's good. So that's really what's happened here, and that's what they talk about this. Okay. Okay. They raised some capital. Okay. Okay. So they had the gold is about 1,100. So I used 1,000. It was 1,100. Well, it's 1,400 now. So it's a good idea to do that. If it had gone the other way, you know, it wouldn't have been too good. If it had gone down, you would have paid them. Okay? So it would have balanced things out. Okay? Okay, so what this company's done is really put it on the same basis with all the other major gold producers. They're all unhedged, so they can take advantage of the price going up. So it's the view then that the gold price is going to continue to go up. Okay? All right, so there's a bit more detail about that. Okay? Okay, anyway. Now the other one is, I don't have on my stick here, which is on, so I'll do that next week. The other one is QBE. So I'll talk QBE. I'll let you read that article, right, and then I'll go through it next week. Okay, that one's really showing the difference between transaction risk and translation risk. Okay, remember I mentioned if you own assets overseas, okay, the value of those assets can change because of the exchange rate. Okay, so it's whether you do manage that risk or not. Okay. But if it's transaction risk, it's actually selling insurance policies overseas and getting paid for them. Okay? Translation is the value of your assets and liabilities overseas, translated back to Australian dollar for reporting requirements in Australia. There are particular accounting standards that explain what to do. Companies are very unhappy with that accounting standard, so it's being rewritten at the moment. Okay, it's going to change. Translation risk is very important for funds managers. Okay, so let's say I have a fund, okay, and this fund has $200 million in it. Okay, and this fund is invested in the United States. So I've had to buy US dollars to buy US stocks. Okay, in the last year, the Australian dollar has strengthened against the US dollar by 10% or so. Therefore, the value of those funds in Australian dollars has gone down by 10%. Okay? So whether they earned any money or not, their value has gone down by 10%. Okay? Because of the exchange rate. Now the issue is that that fund does not have to convert its currency into Australian dollars. It's a paper entry. Okay? So it's the translation risk, but they'll have to show it. What they have to explain that the losses are only because of the currency risk. But investors don't always read that. They'll just say 10% loss. Yes, they're going bad. Okay? So they're not, haven't got the imperative to change them, but they could hedge that risk. So the issue becomes whether you want to hedge a translation risk. In my view, is that a way to do that is to use options to do that. Okay. Anyway, I'll talk about that next week. Okay. Okay. So what I want to do is I really want to ramp it up here in regards to the derivatives. Okay, and particular foreign currency ones. So in particular, most of the foreign currency derivatives are over the counter. That means I buy them from banks or other providers, and generally they're all banks. Okay. So one of the forward exchange contracts, and I just abbreviate it to FECs. Foreign exchange options, we do vanilla and exotics. The exotic option is really only one type, which I do, which are many variations. In fact, there's 16 variations of one type. Okay, that's just of one type. There's 16 different types. Okay. So they're knock-ins and knockouts. I'll explain them really next week. There's binaries, and there's average rate options as well. Now the exchange traded options are primarily within this exchange in Philadelphia in the US. It's the oldest one in the United States, and that's its website. And if you get on the web, you could search and you'll see their contracts there. They sell an Australian dollar option contract. It has a face value of I think it's $67,500. Okay, so they all have fixed face values. All right. Other currency futures. There was one foreign currency option contract, two foreign currency option contracts done by the Australian Stock Exchange. Look, I haven't looked at them for a while, but there's very little liquidity. Okay, here they prefer over the counter. All right, and the currency futures are big in Chicago and London. I don't think there are any currency futures on the Australian Stock Exchange. Okay, but you can get them in all currencies. Okay. Okay, so just to revisit here, what are these characteristics? Okay, of this forward exchange contract. So that's the basic one, and we calculate that using interest rate parity. Remember from last week? Yes, you all remember that? Everyone's awake? Yeah? You all got over the Grand Prix? Yes? Okay. Okay, fixes the rate in the future. Okay? Uses the parity? No choice. The only way you can arbitrage it is if the interest rates are different between what you pay and receive and what the contract is. Okay. Now, Wayne talked before about the carry thing. I think it's part of the assignment, I think, right? The carry trade. And the forward is generally we use the risk-free rates, but it just depends. If they don't use the risk-free rates, or they do use the risk-free rates, and you could borrow the money at a better rate, a relatively better rate, and invest at a better rate than what the risk-free rate shows us, then you could arbitrage it. Okay, it's whether you could do that. Okay, for instance, if I went to Japan and wanted to borrow $1 million, they wouldn't lend it to me. Right? What's my security? Who am I? Can't spell my name. Okay, so you've got other issues like that to worry about. Okay, it's at a premium or discount. Remember, okay, we've got two interest rates. Okay, and intuitively, what did that tell us? The country which has the highest interest rate, its forward market will be at what? Discount or a premium? Discount. Good, discount. Now, if you remember that, you'll never get it wrong. Okay? So the Australian interest rate is higher than just about every Western developed economy. I think it is the highest. So it's always going to be at a discount in the forward market. So it's only a reflection of the difference between the two interest rates. It's nothing to do with whether we think the currency is going to go up and down. Okay? Different market. Okay? Need to be clear. Okay? Okay, it's the most common one. Okay. 70% of hedging. 70% of hedging will use a forward. Okay? Easier to calculate. I showed you last week how to do that. Remember to adjust for the time period. Okay? Or you can even adjust for the number of days in a year. Some countries in the world we have 365 days. Other countries have 360. Okay? Just for calculation purposes. The Americans like nice, easy numbers. Okay? Okay. Any questions? Okay. Okay, good. All right. So this is how we're going to do a hedge transaction. All right. So what I have here is, just give me a moment. Okay, so this is the new improved model, all right? So I can do it from here. Okay, so all right, so we're going to have to pay that many euros in 2 million euros in 3 months' time, okay? So I look at the spot rate, get the two interest rates, I can work out the forward rate, I can put it in that little spreadsheet or work it up, or I can ring up the bank. Or nowadays, if you've got a bank and you do this, you pull it up on the screen and it tells you what it is. You can enter the transaction in on the screen. Okay, just like using an internet banking transaction. Okay, if the Aussie falls against the euro in the next 3 months, it will cost me more Australian dollars to buy the euro 2 million. Okay, this is the identified risk. Okay, because I'm an importer. Okay, as an importer, I want the Australian dollar to strengthen. Okay. Exporter wants it to weaken. Okay? Okay, so this is what I do, right? Okay, so alright, so assuming the rate's 68, right? Okay, and the 3 month rate's 4.25. Australia in Europe, it's 1%. Okay, so I'm just seeing this, I thought I'd change this exchange rate. Okay, 68. So this is Australian dollar euro. Okay? Okay. So it's about, today I think it's about 72. Okay? But when I fixed up the slide it was about 68. Okay? So it's gone up a bit recently. Okay? So 3 month Australian rate was 4.2, assume it's 4.25, and the European rate's 1%. Okay? So that's an interest rate which is standard right throughout Europe. Okay? Eurozone, sorry. Okay? Forward rate, working out these two, okay, is 6588, okay? Alright, I wonder if I did it for a year or just for 2 months. I might have made an error there. Okay, the car dealer buys it forward to hedge exchange, so it's $2 million divided by the 6588 means this how many Australian dollars, okay? So this rate is therefore used to calculate this one here. And you enter into a contract and you'll give them 3 million Australian dollars, and they'll give you 2 million euro, and you'll pay the 2 million euro to the German company. That's how it works. It's a pretty straightforward instrument. Okay? Okay? Okay, here's an example. This is a company that did some work for one time, and they're a crayfish exporter based over in Western Australia. All their crayfish immediately got sold to Singapore, and they were worried about the currency risk. The thing was that the crayfish got caught and it generally ended up in Singapore within 24 hours, so it wasn't a really big risk. Okay, so anyway, so this is what happened then. You're going to receive Singapore dollars in 3 months, spot rate 3 months Singapore rate 5.5, so you've got to multiply that by 90 over 365. Australian interest rate, so the forward rate is 1.2982. Okay? Okay. Okay, now why Why is that rate higher than that rate? Good. Singapore interest rates are higher. So immediately, intuitively, tells us that the Australian dollar in this case is at a premium. Okay? Because at this stage, the interest rates in Singapore were higher. Not sure what they are at the moment, actually. Okay, so the process. Okay. So the process is, what do you think? What do you think we'd need to do? What would be the first step?
Identify currency exposure.
Yeah. Great, you could write it down. Yeah. Identify currency exposure, the risk. Okay, let's go back to the first one. Well, let's go back to the Singapore one. Okay, what's the risk? Okay, the risk is 3.5 million Singapore dollars you're going to receive in 3 months, and you need to convert that to Australian dollars. So, how can we assess whether this is a significant risk or not? What would tell us? Is it a major risk or a minor risk? Major because it's a lot of money. That's a good answer. You're correct. It's major. But it would depend. If it was 3 million and you had a $100 million total, it might not be that important. Okay? But this company, you know, like crayfish is very expensive in Australia because they sell just about all of it overseas. So if they're doing 3 million in 3 months, that's probably 80-90% of their total sales. So you're right. It's identified the risk. Good. Okay, we identify the risk. Okay, we identify what Singapore dollar, Australian dollar is the risk here. So what else would we need to do? Sorry? All right. Okay. Yes. Okay. How do we know? What are we? You're saying check whether it's going to. You're saying check whether it's going to go up or down. Okay. All right. We can work out the forward. Yeah, and that might. Here it says the disadvantage as an importer actually because it's going up. So you might say no. Yes. If there's a bigger spread, that would be quite different. Yes. Okay. What else? Okay, so we'll work out the forward rate, yeah? What else do you think we could do? Okay, all right, now what do you think? What's your name? What's your name? Keith. Okay. So Keith says, right, that we'll look at past data and see whether it's going up or down. Right? What do you think?
Well, you just decide if you want to hedge the risk or not. And hedge the risk or not.
Yeah, you're going to either hedge away the risk or take the risk.
Yeah.
Yep, okay, yep.
Past data doesn't necessarily indicate what will happen in the future. So
Yeah.
like it should be a decision from the risk committee or whatever it is, whether we accept it or not.
Good. What do you think of that, Keith?
We can partly hedge also.
All right, we can partly hedge. Yes.
You can have a
Yeah. All right. Yeah. I mean, they're all. It's a whole range, you know. Yeah.
Could we work out value at risk?
Yeah, we could do that as well. You could run that through the company as well.
And then sort of weigh that against the cost of a contract?
Yeah. And the value at risk would include, you know, the volatility of the exchange rate in the past. Look, I agree with. I agree that what you can say is a possibility to do that. Right? And companies will say, we'll do half, hedge half, and not hedge half. Okay. Okay. So I mean, that's a judgment, but you know, I agree that Wayne says that, particularly in exchange rates, unless you're good at forecasting, then and if you're good at forecasting, you should be working for the bank, right? Then you have to decide whether you're going to take the risk or not. But you might say that historically this currency pair has been pretty close together, and there might be reasons for that. Governments might manage it, but still, it's still a lot of risk. So I agree that you have to decide that there is this risk. The past data will perhaps illustrate the extent of the risk. Okay, right? For instance, huge risk South African rand, Australian dollar, because South African rand goes up and it moves big time. Okay, so you have to decide that you're either going to take the risk or you're going to actually buy the risk management. Okay, and the thing is that you have to do that on now. You cannot rely. You cannot put your risk management strategy in place based on your forecast of the exchange rate in 90 days. I mean, that's something that you have to learn from this course. Okay? So a fixed exchange rate is Hong Kong dollar US. Okay? But the thing is that the government can change that exchange rate overnight. And that's when you get the biggest moves. So it'll be interesting to see what is the hedging of that. The hedging, the forward on the Hong Kong US dollar will probably be pretty close together anyway, so it's probably not so significant. Okay, so the idea is to think of what it is now. Does this work for my business? And it's no use going back and saying that I should have done this, because you can never get hedging correct. Okay?
How much does it sort of cost for these contracts?
It's small, $100, $200. The actual contract itself is a paperwork of a signed transaction which is done electronically. So there's not...
So that's based on a percentage of the national value?
Oh no, it'd just be pretty fixed for particular amounts of money. I haven't seen the cost of one recently, but they're not, compared with the whole transaction, they're not going to go up to thousands and thousands of dollars. No, it's just... But the cost is, right? Your question's good. There is a cost though. Okay. The cost is that you're entering into a transaction to exchange money in the future. Therefore, what's the risk for the bank? No. What's the risk for the bank? Okay, the bank is putting aside these Australian dollars for me. So, what's the risk that the bank has? Yeah, default. Say, for instance, the Singaporean company does not pay me. Okay, and the bank has got the transaction with me, and I haven't got the Singapore dollars to pay the bank. Okay.
That's also your risk as well.
Yeah. Yes, it's the same. Yes, it is. The company's got that risk as well. I've got no problems with that, right? But the thing is that the bank has that risk. So therefore, the bank might want some security regards that. Okay, the security could be, the contract with the other company. Like you have to show the contracts. Okay, if you've been doing this regularly for 10 or 15 years, bank's probably not too worried about it. Okay, but if it's a first-time one, they'll want your company to put up some collateral for probably maybe 70% of the value. So therefore, you can argue that there's an unseen cost. You won't see that explained anywhere, but long-term relationships all the time, the bank's not going to worry about that too much. Or you can take look, it's easy to do. You can insure that. Okay? So the insurance is that here within Australia for exporters, we can use an insurance company called EFIC, Export Finance Insurance Corporation. So I can insure that payment. I can pay perhaps 1.5%. It's $3 million. It's going to cost me $30,000. I can insure it. Now, if I've insured it, then that takes the risk away for the bank, and then the forwards. Okay. So there's a bit of negotiating there. It's not just simple get on the phone and ring them up, because they have got risk. But they want to see paperwork. So if you've got relationships happening all the time, then it will be just pretty standard. Okay. But the cost of things is nothing like the premium on an option. Okay. The forward might cost you $300. The option contract might cost you $20,000. Okay, so we did. So what else in the process? One, we had to identify the risk. Secondly, we had to decide whether we're going to take the risk or buy it, buy a risk management product from elsewhere. Thirdly, we have to find a bank and we have to enter into the contract. Okay, so we have to do that. Fourthly, we need to collect the money and complete the exchange in 3 months' time. Okay, so that's easy to do. Then after that, over time, you'd look at, you'd audit the process. Did it work all right? Did the bank actually give you the rates it said? Okay, so you'd have some controls in place as well. Okay, so if you look through the study guide, you'll see that there's about 8 steps really. So I've gone through them a bit quickly here, but you can look at those steps, and this one's a relatively simple transaction. Okay, as Keith mentioned, the partial hedging. Okay, so the idea here is to say, all right, we've got 3.5, we'll hedge 2 million and we'll leave 1.5 million unhedged. Okay, hoping that the Australian dollar will appreciate. Okay, and then if it goes up, we let it go. If it comes down again, then we hedge again. Right? There's all sorts of ways you could do it, but you could do this. Okay, and I'll show you some other methods that use something like that. Okay, you can't get rid of all the risk though if you do that. Okay. Okay, so many companies use the forwards. They just match it to invoices. Okay, so one way of doing it is to say, today, I've got the order for the crayfish, and there's the invoice. And then tomorrow, there's another invoice. And then there's another one the next day, and another one. So I ring up the bank each day, do it online. I enter into 1, 2, 3, 4, 5 forward contracts. I pay the fees on every one of them. Okay. So a better way to do it is to give me back all that money. Okay. You give me back these contracts. Okay. So give me back all of these contracts. Okay. Good. Yes. You can get one. All right. It's a tough day, eh? All right. Okay. So I get them all back. But the thing to say here is a better way of doing is to say, how much money will I need for a month? Right? Okay. So if you, instead of doing them every day or every couple of days, it takes a lot of time, is to estimate how much you need for a month. And here in the past, this one's of 3.5, but generally doing 4 million every month. Why don't I just buy a forward exchange contract for 4 million? So it's one transaction. Saves doing a whole lot of transactions and paying the costs and having to track it. Okay? So many companies just do invoicing and they fix it to that invoice. It just takes a while to do. Okay? So some hedging may be for as long as what's mentioned there, is for 3 years. 3-year hedging is often on big commodity projects. I doubt whether there will be many very much 3-year hedging now because the markets have been pretty volatile in recent years. Okay, so you wouldn't want to be selling gold now for a contract you entered into 3 years ago for $600. That's $1,400. Okay, you go out of business. Okay, so companies would have bought their way out of those things. Okay. Okay, so we know about the interest rate differential, don't we? Good. Push that one a bit. Okay. Sorry, Keith. Sorry. Yeah. Yeah. So I mean, I guess that's really part of the process. Really, we should have looked at first is to think of do we, as well as exporting, do we import? And you can net them off. Okay. So nowadays it's much easier to have accounts in foreign currencies at your bank. It's not so easy to do with the 4 major banks here in Australia. But I gave advice to one of our staff members who came from overseas, and they went to HSBC, and they found their service to be very good. Is that HSBC, it was easy to have US dollar accounts, Hong Kong dollar accounts, euro accounts, and you could wait to do that. Now companies could always do that, and you could deposit the money in that account and wait till the exchange rate changes, okay? But often that's a cash flow issue. Often you need to exchange it pretty quickly to pay for all your business expenses. So often, but you can still hedge them off, okay? They need to be in the same period of time, obviously, okay? For instance, I have money in a broker in the United States, and I've been waiting for the Aussie dollar to come down and bring it back, but I've lost 10% on it, right? I think, right? I won't look now. But what I'm trying to do is, if I can, bring it back to a broker here in Australia that will let me use US dollars. I don't want to take it into Aussie then back to US, even though I could do that and just pay the fees. But I want to leave it in US dollars until the Aussie dollar comes back to 80. And I don't worry if it's 5 or 10 years. Okay, so that's a decision I have to make. Okay, not a lot of money, but you may as well not throw it away. Okay, but you're right. You could net them off. Yes. Okay, so this is a borrowing one. Okay, and this is. I have mentioned it before, and this is not quite the same as a carry trade, but relatively similar. And there are plenty of examples of where this has happened. Okay, is that if I'm a property developer, and property developers always need money. Okay, property development is really management of debt, in my view. Right? 70% of the money, or 65 at least, will be always borrowed. Okay, so he wants to borrow 5 million Aussie in equivalent yen to take advantage of lower interest rates. Okay, interest rates payable 6 months in arrears, hedged or unhedged. Okay, so he's borrowing 5 million. Okay, that's about about 80 yen to Australian dollar. So 5 million by 80, what's that? 400 million yen. So he borrowed 400 million yen, and he can get it at. Hopefully, he could probably get it at 2% or 2.5%. Okay. So, should he be hedged or unhedged? What do you think? Well, it's not a carry trade if you hedge, but you can hedge. Yes. Okay. So he could hedge this transaction. Okay. But as soon as he hedges it, the forward rate reflects the interest rate differential. Okay, so there's no advantage in to do that. Okay, the alternative is that he takes the risk that the Australian dollar will appreciate in the future and the yen depreciate. So when he comes to pay back the 400 million yen, they cost him less in Australian dollar terms. Okay, now there are not many, but probably a large number of Australian companies have done that in the last 20 years. And many of them have lost because the Australian dollar at those stages weakened. Okay, and so instead of paying back 400 million yen, in Australian dollar terms, you have to pay back 500 million plus the interest. So a quick way of going out of business. I told you about the movie The Bank, didn't I? The Bank. Okay, get the video, DVD of The Bank.
Swiss francs, wasn't it?
That was Swiss francs. Yep, same thing happened in the 1980s with Swiss francs. Okay, and I gave a presentation one time in Brisbane, and a guy came up to me. It was on currency stuff, and the guy came up to me and he says, "Look, I work for a sports club in Queensland, and we borrowed Swiss francs in the 1980s to build a bridge. Right, to build this bridge. Okay, they were obviously in a rural community, and he said it was the most expensive bridge in northern New South Wales because Swiss franc went up and it cost them about twice as much money." Okay. So that was one example there. So The Bank is a movie which is about that. Okay, and actually most of the people who lost money on that were actually they sued. Westpac Bank in particular was the one that got sued. It went to the Supreme Court, and it looks like the bank were going to get through until a particular email surfaced, and in this email, one of the senior bank officials said that the people that we've been selling these instruments to do not understand what risk they're taking, and we haven't told them what the risk is. So as soon as they found that email, the court case was over. The bank was found liable, and that was Westpac, and consequently Westpac nearly collapsed after that. Okay. So, just borrowing overseas and investing in Australia or developments in Australia is not so prudent. But the thing is that if you are an exporter, right, so if I'm a company like Foster's, like BHP Billiton, and I earn a lot of money from overseas, QBE is another one, therefore it might be prudent for me to borrow money overseas. Okay? So if 50% of my revenue is from overseas, why don't I borrow, if I need borrowing, borrow half of it from overseas, because I'm earning this money and that pays off the loans. Okay? So you'll find that if you look at BHP Billiton, for example, you know, the largest mining company in the world, it's got borrowings from all over the world, but it's got currency earnings all over the world, so it's naturally hedged. Okay? So only if you're borrowing, really. Okay? So that's really what that one talks about. Okay, so here's the comparison. Okay? It's the comparison between over-the-counter and exchange traded contracts. Okay? So what I want you to do is, okay, how could we expand on those differences? Okay, I've talked a little bit about them, okay, from your other studies and so on. I'm just going to have a break for a minute, okay? And how could you explain those differences? They're more or less one and it's different to the other, okay? So I'll let you think about it. How could you explain, you know, what does it mean? One's flexible, one's standard. Where would you buy it? Is that good or bad? Okay.
You can tailor your needs when it comes to OTC.
Pardon?
You can tailor according to your needs when it comes to OTC.
Which one's that?
Flexible contracts, right?
Yep.
You can go and say you need it for 75 days.
Yep.
If you go to a exchange traded contract, you can't get 75 because they have like 30, 60, or 90.
Yes. Yes.
Whereas you can go over the counter and say like you need it for 15 days, 20 days, 7 days, they tailor it and they make it according to your needs.
Okay, what's the other way in which they tailor it? You're correct. What amount did you say? Yeah, did you say an amount?
So for OTC you can actually tailor it according to the amount that you require.
Good. So if I wanted 125,000, I could do that. Okay. So an exchange contract will be what the exchange says. An exchange might say 100,000, 200, or 500. Good. Okay. So that's answered the first one. Okay. So you can tailor it exactly to what you want. Now you can. Anyone know how you could get around the timing issue though? The 30, 60, 90 days. How
If
could?
there's a secondary market, you buy a contract that's already sort of into its period.
Yes, I know, but there's not a secondary market for forward. But what is there a secondary market for? Futures. Yeah. So you could, you know, the futures is really forward contract, you know, with particular requirements on it, traded on an exchange. Okay, because a forward contract you can buy it for 60 days, but you can sell it beforehand. Forward exchange contract. Remember, I had to do the negotiation here to sell it. Can't go onto the market and sell it. There's not a secondary market in forwards because they're too tailored. Okay, so the futures do that. All right. So all right. Well, that was a good response. Okay. Okay. Wide range. Well, effectively that means that could be any amounts. You know, a lot of different currencies as well. You could get them in. The currencies will depend on where the banks come from. Okay. So you know, you can do major euro, Aussie dollars with, you know, all the major banks here. But, you know, if you're doing a South American currency, you might look at a South American bank, for example. Okay, it's become a bit simpler with the euro. Okay. Okay, what's this mean? The non-regulated and regulated.
Someone is taking care of that. Seems to be the governing body takes care of that.
Who's the governing body?
ASX or some
ISX will have policy. Yep. Yeah, ASIC, these contracts will be regulated. Okay, if they're on an exchange, the contract is standard and regulated. Okay, if it's on an exchange. Okay, you can go to the exchanges. You can probably pull up a PDF of the contract. Yep.
Would FIDO get involved in that sort of regulation, or is FIDO more for retailing?
No, FIDO will be more retail sort of stuff. Yeah, yeah. So you know, so I go to the bank, and I enter into the contract. It's sort of non-regulated, but essentially the bank is to some extent regulated. Okay, so, but it's not the same as the product being essentially regulated. You know? I wouldn't do a forward exchange contract with particular banks. Okay, I had a credit card debit taken out of my account previous week, right, from a bank of Cyprus. Okay. So I contacted whoever did this and said, is that who they're using? All right, because I wanted this contract cancelled, okay, and the money refunded actually. And they said it was theirs, they just used Cyprus for that part of the world, okay. So I hadn't seen it before, okay. All right, good. Okay, so liquidity then. You know, because these things are not traded, there's no secondary market, there's no liquidity really. Students will say, well, why don't you create a secondary market? It's too different. Okay, too different. Okay, these things are easy to price. Okay, these ones is more complex to price because you negotiate the price here. There's a futures formula. Okay, there's an option formula. We'll do the option one. You explain more. You got to negotiate the price, but you know you can see the price. It's opened. It's transparent. It's available to everyone. Okay. Limited secondary, low cost, minimal risk because of the regulation here. Okay, you don't have to put as much money down. Futures contract, very small amount of money. You might prefer a futures contract to a forward because a forward requires credit limits and things like that. You've got counterparty risk with the bank, and here your risk is margin calls. Okay, so need to be able to explain them a little bit. Okay, but you do need to have some knowledge of futures markets and options markets. It does help as well. Okay, so what I want to do now is just all I'm doing is currency options. Okay, the currency options outside of equity options, they're the biggest users of options in the world. And if you look at any data on options use, it's like this, and it slowed down in 2008, and then it goes up again. So they're principally just about all over the counter. Okay. Okay. So, who can indicate to me that they have a reasonable understanding of options, just stock options? Anyone? Reasonable? Okay. All right. So I can make an assumption. Okay. All right. Well, I assume that you don't. Right. Okay. So that's handy, okay? Okay, so, all right, so what we have with currency, what an option is, okay, is the right to buy something or to sell something, okay? It's a right to do something and you pay a fee to do that. Now, the options are everywhere, okay? If you think about it, I do a lot of work within these things, and options are everywhere. I bought a television yesterday. I got an option to do a 1 year or a 2 year warranty. Okay, and the longer one, the 2 year one, cost me more. It's an option. Okay, so options everywhere. They're in property. You buy a car which has got all these different options on it. Okay, all right. You buy an airline ticket that. It means that you can travel all around the world. You know, young Australians travel overseas, they buy an airline ticket, costs them $2,500, they can travel around the world. They've got to keep going in one direction. But there'll be a maximum number of stops that they can have. Okay? When they increase, they say you want to have 7 flights, they're all going in one direction, 7 flights, it'll cost you $2,500. As soon as it goes to 10 flights, it's $3,000. The airline is charging you for more options. So what it does is an option has value. Okay? And effectively it's like choice. Okay? So what's happened here is that in financial terms, we've converted that choice and we've developed a model that values options. Okay? Now options have been around for 400 years. I can go through a whole history, I won't tonight. Okay? But they've been around for a long time. But it's only really since 1973 that they've been valued, that there is an option pricing formula called the Black-Scholes option pricing formula written in 1973. You can read the article in the Journal of Financial Economics, I think it is. Sorry, Journal of Political Economy. Okay, 1973. So remember I told you academics, all the people I work with publish articles, even me, right? And the best journals in the world are called A-star journals. And they make up 5% of the journals in the world, okay? If you publish 2 A-star journals, you're more or less guaranteed of a professor's job, okay? That's how hard it is. Then there's A journals, right? So the guys who wrote this journal, this article, could not get it published, right? So the Journal of Political Economy is not a high-ranking journal, but they got this mathematical formula developed, they got it published, okay? The options market was trading on stocks in the United States at that time. The pricing was all over the place. A few brokers read this article and they used the pricing model and they made a lot of money. They made a lot of money because their price very closely approximated what the market price became, okay? So when the market price was undervalued, they would buy the options and they'd go up, right? Simple like this. Eventually, everyone started using this model, and if you go onto a broker's site now, you can put in a theoretical model and it'll sit right between the bid and the ask. Okay, I've done it myself. Liquid markets, this model works. The other view is that the only reason the model works is everyone thinks it works. Right? So you wonder, okay. So that's called the Black-Scholes option pricing model. So 1973, 1998, 25 years old. Okay, it's the only party I've ever heard of happening. Everyone in New York dressed up in a black tie and went to this big hotel for a big party. They celebrated the option pricing model. Why'd they celebrate it? Because they'd made millions of dollars using it, right? 1998, okay? So it's Black and Scholes and Miller is the other one, and it got a few variations to it. But essentially, they developed a theory that created the option model, okay? And then the option models become very important in financial circles, somewhat abused at time, but certainly particularly important. It's used, its growth is significant in the use of managing currency risk, because that's a very big market is currency risk. Okay, so what these, you know, the call option is the right to buy something, so I pay a fee. Here's a good example. Here's one that I've used. I wish I didn't, but I did use it, right? Is that, okay, there we are. You've got a block of land, okay? You've got a block of land near Deakin University. And I think, oh, I could buy that block of land. Oh, it's all these students, they've got to live somewhere, don't they? I could buy this block of land. But the thing, it's got a house on it. Now, could I buy this block of land and I could put up 8-storey building on it? Okay? Right. Well, let's tone it down. You always ask for 8 and the council gives you 3, right? So anyway, that's how it works. So what I want to do is this opportunity has come up, and what I want to do is I don't want to buy the property yet because I don't know if I can get apartments built on it. Okay. So what I do is I'll give you some money. You've got the block of land, right? I'll give you some money. What I bought is an option. What's your name? Yuki. Yuki has sold. I've paid you some money, Yuki. You'll be happy, right? So I've paid Yuki $5,000. She's given me the right to buy this property at $500,000. Does that be enough? Yeah? Okay, $500,000 in 6 months' time. Okay. So this is a contract. I had one written up myself. I have an option contract. Had to explain to the solicitor what an option was, but anyway, he did it in the end. Okay, right. So you ever deal with lawyers? You have to explain what you want for them. Okay, and then they charge you for explaining it to them. That's my experience. Okay, so I've paid $5,000 and I've got this. You cannot sell it to anyone else. Okay, sure. Okay, you cannot. Right. So it's a legal document. So what the option has given me here is that it's given me control over that property. Okay. So what I do now is I go to the local council and I've got 6 months to find out if I can get the right to build 4 apartments. You know, 8 apartments on that block of land. Okay. Now 500,000, 8 apartments, sold them for 400. 8 by 400, $3.2 million end value. I'm happy to give you $500,000. Okay. So the thing is, that gives me the right to do that. Okay. Now, if I find that the zoning won't allow me to do that, there are other caveats or there are restrictions on use of that property, then after 6 months, I just walk away and you keep the $5,000. Okay? But if I had decided to do that, I would have to exercise the option and you would have to sell me the property for $500,000. Okay? So if I was able to get the planning permits and all sorts of things like that through, then I would I would proceed with it. Okay, so really there's a value in there. So what do you think is the real value of that option contract? What's it made off of? Pardon? Yeah, I got flexibility. Good, excellent. I got flexibility. Now what else has it given me? I've got control, yeah. Expectations, yeah, what I want to do.
Could you say the future profit from carrying out this enterprise, multiplied out by the probability of it happening, something like that?
Yeah, I could do a valuation based on that, beforehand even, yeah, if I wanted to do that. Okay, there's one key thing here. It's good to give me an option. I've got an option. Okay, why did I buy it? Why did I pay for it?
Prevent somebody else.
Prevent someone else. Good. That's one. Yes, competitive. Yes, that's a good example. But what have I bought from Yuki? Okay. All right. Write it down. I've bought time. Okay. I've bought time. I've bought. What did I say? 6 months. I've bought 6 months. Okay, you're correct. I've kept a competitor out of the market. That could be a major reason, okay, that I'm doing it. Because I know there's some other developer out there, looking around. So I've got control, right? So the other thing is what I could do is, let's say that Steve here is the other developer. He wants to come in, right? And I could tell him, okay, Steve, I've found out this. I'll sell you this option for $50,000. Now you've got the plans and permits, everything. He pays me 50, and then you still have to pay Yuki 5,000. Bad luck for you. Okay? Right, so you could trade them as well. Not a really good, in property, non-liquid market, right? But you could trade them like that. So the big advantage with the option is it buys me time. Now if I bought that option for 12 months, it would have cost me more money. If I bought it for less money. Okay, so I've done this. Okay? Right. So the thing is that I then thought, why don't I try and develop a model for property options? Because they're a bit different, right? But in property they either pay $1,000 or $5,000. I mean, anyway. So the option gives me the time to do something. The time gets valued, and the time is incorporated within the option value by the interest rates. Okay, so that time is important. Okay, so what happened with me? That gave me the time to do the financial analysis. Okay, which someone got wrong, not me, someone else. Okay, in my experience. Okay, and in hindsight, I should have walked away from it. Anyway. Okay, any questions there though? There's more to it than that obviously, right? But that's a good example of an option. Okay. We could have had the other opposite. Yuki could have also entered into one where she had the right to sell it to me as well. Okay? So I could buy from her the right to buy, and she could buy from me the right to sell. And I could pay her $5,000 and she could buy me $5,000, right? So at the end of the 6 months, either one of us could exercise. Okay? So if you exercise the right to sell, I had to enter into contract to buy. Now the advantage with that is that you don't enter into a legal contract to buy or sell, so it's simpler. Okay, so you might do that. Gives flexibility to both parties. Both parties might walk away from it too. Anyway, tricky one, that one. Okay.
Russell, how do you actually find someone to enter into one of these contracts with? I've actually heard quite a lot about these property options, and actually, as you said, actually getting an option, getting some kind of plans in place, and then selling them to another developer without having to actually purchase the property itself.
Okay.
But how do you actually find? How did you find that individual to enter into that contract with?
Well, we entered into a contract between the seller of the properties.
Oh, but how did you actually find that individual to actually do that?
Well, my partner knew the properties were up for sale. It's two properties side by side.
Actually up for sale, and then you just
Well, he found out they were. I mean, I had a partner who, it was a big bit of land in Glen Waverley, 3,000 square metres. So he knew the people and offered, and we paid him $1,000 for a 30-day option. Okay.
Oh, okay.
Yeah.
I was going to say, because obviously, a lot of people might be hesitant to actually.
Well, your question's actually correct. They say, what's this hocus pocus? Who's going to pay me $1,000 for the right to do this? So, within the professional property development industry, it's pretty standard. Okay. So there are people who own commercial property that might willing to sell it and might sell an option to someone to do something else. That would happen there. But when you're dealing with the retail market, you have to do a bit of work in selling it. Okay. I had an opportunity of a property in Furniture Gully Road, through an agent that worked for me, and we were going to put together a group to buy something because we knew that we could get it rezoned, and it was big, and the person we knew wanted to sell. He said I only wanted to give an option, I didn't want to buy it. He said it's too hard to explain it to him to do it. But, so that's the thing. But generally, if you go up and say, there's the money, and all I need is the right to be able to buy this in 90 days' time, and if people are going to sell anyway, they'll take the money. But absolutely correct, it is difficult to sell. Okay. So you'll find that sometimes that's what developers use. So how the growth in Melbourne's so enormous that there's land outside Melbourne where I know people who have bought land outside of Melbourne, and they've bought land which is zoned farmland, but they've bought it right next to a railway station. Okay, and the zoning is that you cannot build houses on it, but their analysis was that Melbourne was just getting bigger and bigger, and eventually the local council's going to have to zone it, right? So these people would have bought property for probably $300,000 or $400,000. There might be 20 of them, and 3 or 4, they'll probably sell it for $4 million. Okay, as soon as it gets rezoned, the value goes up by 10 times sometimes. Okay, but you take the risk that you can't get it rezoned. Okay. Okay, so that's a good application of the options, and one that's sort of relatively easy to understand. Okay, it's very easy generally to understand the call option, the right to buy something. It's more difficult to understand the right to sell. Okay, but that has value as well. Okay. So what happens with these options is you can sell, transfer, price, and take on risk. Okay, so I can sell something using these options. I can transfer the risk to someone else. Okay, I can sell the risk to someone else and I get paid. I can calculate a price, a value probably should be there. Or I can decide to take on risk. Okay, these options allow you to manage the risk. Okay, so my own experience is dealing with exchange traded options except for the property deal. And these are the two major brokers in the world for options. Okay, so if you're interested in your own research, you can go to Think or Swim. Okay, it's free to sign up. And 11:30 at night, their market will open. Okay, this is an incredible website. There's 6 options exchanges in the United States. And this broker, if you put in an order to buy or sell at this broker, they immediately check the price in these 6 exchanges, then they supposedly get you the best price. Okay. The other one is called Options Express. Okay, this one is now owned by a Canadian bank called TD Dominion, just last year, and that was the first options exchange. They used to have a branch here within Melbourne. You could use them in Melbourne, and they've since left. You can trade their options on the Australian Stock Exchange, just on equities, okay? But they're very illiquid in my view, okay? But I have a friend, he's a retired butcher, and he makes money on the options market. That's what he does now, okay? So I gave you the background, 73 was the article. Okay, so the currency one, currency pricing uses, as you can cut out, the Garman-Colhagen model. Okay, so this is a slightly different model, okay? Is the equity option model has one interest rate, the currency one has 2 interest rates, the equity model, the basic one has a dividend, and currencies don't give dividends, so no dividends. So that's the difference. Everything else, what's called a strike or whatever, okay? So essentially, this is how I would use the option on the stock market, okay? So if I've got a share price, okay, which is at $100 is the share price, and if I'm a speculator and I've got good information for my own analysis, the share price is going to go up. And if I think it's going to go up from 100 to 105, I would make 5% on my money and I'll outlay $100. But really, if it went up from 100 and it was good evidence it would go from 100 to 105, I wouldn't do that. I'd buy an option. Because I could buy the option for $1. And then if it went up to 105, my option would have to be worth $5. So I make 500%. Okay? So that's why I'd use the option. But if I bought the right to buy it for 100, okay? But if the price went down to 90, I'm not going to buy it for 100, am I? So I walk away. Like, you know, if I couldn't get that zoning, I wouldn't go through the deal with you, but I didn't have to. So I walk away from it, so the option lapses. So either an option is exercised or it lapses. In financial markets, in stock markets, about 80% of options lapse. That is, people who buy them don't use them. Okay, it took me a long time to understand that. Right? The people that make money in options are the people who sell them. Okay? I have another staff member that every month he just sells options, a couple of options. Okay?
So what are the excess prices? Is it will it be percentage or is it a fixed price? Excess price of option?
The exercise price. The exercise price is the price I can buy the stock for.
Percentage of the transaction or a particular?
No, it's just a price. It's a fixed price. Okay.
So unit or?
Well, I mean, you know, if the share price is 100, okay, so there's very few in Australia 100, but I'll use the US market. If the share price is 100, it'll have options to buy it at 100, at $102.50, at $105, $97.50, and at 95. So if the option is 100, I could buy the right to buy it for 95, but I'm going to pay more than $5 for it. Okay. So if the options are just $10, they might be strikes at 9, 8, 7, things like this. Okay. So the options. Okay. So the interesting thing that happens, because I got into this because of one of my students. Okay, he did the research, and we set up a fund to trade options. Right, and I shared that with you, and it didn't lose any money, thank goodness, but could have. Right, is that the market moves so fast. Okay, so and we didn't have much experience. Okay, but what happens is that. What happens now is the minimum time you could buy an option for it, they generally go for a month as a minimum. Nowadays, they can go for a week. It's unbelievable. You can get weeklies. Okay, so they can go for a week, or they can go for about 2 years. So in another unit here, a couple of years ago, I taught the students how a methodology for doing this, where you buy an option, for it's like I buy the right to buy this block of flats, if you like, but I buy it for a year, and I get control of it, and then I sell parts of it each month, and I get that back. Anyway, I won't go into it. It's called spread trading. Anyway, so I mean, they give you a credible. The best thing is to go onto that site, and it's free. You can get into it, and your computer terminal is okay. It is phenomenal, the information. Okay, it is just, and it's free. Okay, I don't think though you can get a demo account. I think for free. Okay. Okay. All right. I'll just finish up with this slide. Okay. So this is a good website, FinPipe. I don't know what it's called, Financial Pipe. I don't know. .com derivatives. This side here has a whole lot of little short articles on different types of options. So here, obviously, I'm going to do some currency ones and do some exotic ones, but that gives you a whole lot of different ones. Okay. All right. So I'll just we'll just have a break for 10 minutes. Okay. Chance for some of you to go, I guess. Okay. So I'll just finish here for 10 minutes. Yes?
On Nicole.
Nicole.
Here you go.
Good, Nicole. What was her name?
Check.
Over in Thailand. Okay.
Yes,
Yeah, okay.
it was beautiful. It was gorgeous, 35 degrees.
Yeah. Because I was in Lima and
Oh,
not
okay.
too far.
So,
Yeah, I know.
thank you very much for
That's all right. So, okay.
Yeah. I'll stay, but
Yeah.
So he's going.
Is that exactly what
That's Alex.
What if you email me with the explanation?
Plus he's already organised.
He's going to be alone. Okay. Yeah, well, it might be therefore difficult to get someone else who is equal to manage that time
Or
frame.
someone that's been set up to where we're at.
Is there any other units?
No, but I work I'm trying to come
So you work at financial services?
Yeah.
Are you doing them on your phone or is it over your iPhone?
Masters in Wealth Management.
Oh, you're doing this on your phone?
Thank you. So this is my last one. And it'll be on the 10th. So timed it well to do my last subject.
Well, have you found the wealth management service?
Good. It's just relevant, very relevant to the day.
I just can't get it. Or we changed that course.
Yeah,
I did that. I took it last because you felt it was it's too hard to get students who have done this course as a postgraduate. So here you can do that anyway.
yeah.
You have to think of that's a good course. We just need to do it too. Lost them. You have to example.
No, I don't have
The time that comes from.
Yeah, no, because I've got a few exemptions. So I'll see if
Oh, right. We had a guy but he runs a big fund.
yeah. I think CFP will be pushed.
Yeah, see, that's there too. You don't do a degree.
Will become that.
That's what they want to do. So they have to be very qualified. So you have to sit there and have to that
But I think CFP industry will become really not too in the future, and then I think there'll be a lot more room to my systems.
Okay, if you notice any jobs that you know, or something that you're working on.
Oh, really? When will he start?
So he has to start with that. He has a promise to work in there.
Yep. Thanks.
He's
Fits into one of the big banks. Just as a start. To win it.
still young. Melbourne's different. Done a lot of property investment. They don't do so. What's that? You've got to do our job.
The banks are
Yeah. I mean, let's get you the whole look and get some of
But it's good to know.
But you see from what I do, the most of I do is technical. I'm doing weird stuff. I'm using other words. He's forecasting technical. It's not control technical. He's forecasting technical. It's model forecasting. Because I don't know, because if you're serving people in the electrical industry, I believe it. So BlackRock has got a pure platform. It's a computer thing. It's of years. So they're working with just as a
Big change.
and my stuff I do in currency. I find to currency, it's very hard. So they do it with stocks. Okay, good to meet you. Yes.
Sorry, sir.
Yes.
And I
Well, we have a chat at the end.
the fund.
Yeah. Okay, if you email me tomorrow.
That's fine.
I can do that. You email me tomorrow. You see, I spend most of the time withdrawing.
Yeah, that's right. By the way, you've cut it.
I'll withdraw your business. You have to just. I can talk to you
Yes,
yeah. You pick it up well, it's interesting stuff. And as you see from what I do nowadays, comes from what I did this some time ago in the students he knows how to structure the deals. Technical stuff. Yeah. Oh no, not all of the knowledge, no, but the stuff I embellish with some of it is. So I've used the stuff myself. Hedge risk for companies. I've bought stuff on those websites.
traded it. I trade currencies tonight.
Because I'm not very keen on the finance, especially the treasury. But I just lack of the assets to this
Yeah, I know.
knowledge,
Yeah, I know.
this class.
Yeah. Well, that might happen over time.
For the injury, luckily.
Yeah, that's fine. That's fine. Okay, what's your name?
Adam.
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 Okay, email. I can fix it up tomorrow.
Have you emailed it now?
Okay. Okay. Okay, we'll go. Yes. I've got this little eye lecture buzzer here, and I'm not sure whether it's working or not. Anyway. All right. So there's a bit of work for you. Okay. To have a look. You've got to get. No one's looked at Forex Factory. I can't believe it. Okay. Okay, so these are the, how do we say, these are the core, notation, if you like, okay, of the options. Okay, so if you draw a line between them, so the call, so the problem with currency options is when I have the right to buy Australian dollars, I also have the right to sell the other currency. So it's one contract. Okay, so here I've got a right to, call is a right to buy Australian dollars. Okay, so I have the right to buy, okay, and if I sell, I could sell this option, that gives me an obligation to sell if people want to buy from me. Okay, so it works like this. Okay, what's your name? Wadini, okay. Okay, so you sold me an option. Good. Okay. Wadini has sold me an option. I've paid her 20 grand. Okay, yes, she's happy. $20,000 for this option. I've paid her. Okay. Now, depending on what the contract is, the contract will have a couple of things I'll talk about later. But whatever it is, at a particular time, I can exercise this option and I can buy whatever she's selling to me. What's the underlying risk I can buy? Because she sold me the option, she's got an obligation to do that to me whatever I want. I control the transaction. Okay? So you should only sell what you own. That's not always true, but for this purposes we'll say that, right? You could also sell what you control though, but it's a bit more complex. But so she's got an obligation, I have the right, that's what it is. Okay? So the other one is a put option. Okay? Australian dollar, which is a right to sell Australian dollars. So if you're selling Australian dollars, you're buying another currency. So importers buy puts because they need to sell Aussie, buy foreign. Okay? Again, it's a right to sell. The other party will have the obligation to buy from you. Just the opposite. So you put it in a 2x2 matrix. And essentially everything goes from that. The right to buy is pretty easy to understand. The obligation to sell, yes. The right to sell is a bit different. Okay? Wonder why, but I'll show you how you use it. Okay? And the other party has the obligation to buy. Okay? So I can force someone to buy something from me as well. Okay? So that's the other side of the transaction. Okay. So these are all the aspects. Gives the buyer the right, but not the obligation to buy an underlying asset. So underlying that underlying asset, because whatever the asset is, I can create an option. As long as there's a market. If the price moves up and down, I could create an option on it. Even if there's not a market, I could create an over-the-counter one. Okay, I could create one for a property. Even though the property price doesn't go up and down every day, we agree on a value, okay, on a price. Okay, so the underlying asset can be stocks, it can be bonds, it can be property, it can be commodities, okay, it can be drugs, I suppose, anything. Okay, specified exchange rate, and this is the strike price. The underlying asset goes up and down, and you determine the strike price. And depending on the strike is what you buy it at, on or before a specified date. So, an option's got a time period, right? So I get the right to buy it in 30 days or 60 days. Okay. Now so that's one type of option. Okay. That's called a European option. Okay. I buy the option now. I can only exercise it in 30 days. Okay. The other option is called an American option. Okay. And the American option, you can exercise it at any time. I can buy it now, and I can exercise it whenever I want to. Okay. So US markets use American options. Okay. Okay. But me, I can't understand the difference. You know. Pardon? Yeah, I know. Okay. But the option, yes, they should be more expensive because you're not fixed to that time period, and the puts are more expensive. Okay, but what people don't realise is that why I buy an option that I can only exercise in 30 days, but I could sell it. You know, this option, okay, that I bought from you, I could sell it to you, Keith. Okay, after day 3. Okay, so it's a bit scary though, because the first time I ever bought options for a period of time, I got exercised against. Okay, so I bought options for, let's say, $200. That gave me control of probably $200,000 worth of assets. Okay, and then they exercised against me. I couldn't believe why they exercised. Okay, they shouldn't have exercised, but they did, and suddenly I owed $200,000. So I had a sleepless night. Anyway, I immediately turned it around the next day, right? And it was more or less came out zero. But it was a good lesson in learning that they were American options. Okay. So you can generally predict when they would exercise against you, but this is what happened. Okay. So now something. I don't trade them at the moment, but a thing comes out to me every month to warn me that it might happen. Okay, the seller of the call has to deliver the foreign exchange, which is the asset, specified exchange rate, strike price, whenever the option's exercised. Okay, so that's the other side. So the AUD. So this is really how you can understand the things. How do we use them? Australian dollar call option is used by an exporter, if I remember. Yep, by an exporter. Okay. So the exporter needs to buy Australian dollars because Australian exporters primarily will get paid in US dollars. So I receive US dollars, I have to buy Australian dollars. Okay? So the exporters receive US dollars, okay? So they like their US dollars to go up in value. Okay? And the Australian dollar to go down because they buy more Australian dollars. Okay? So the exporters want the Australian dollar to go down, the importers want the Australian dollar to go up. So once you realise that, you remember that, you know which one you're going to buy. So if you want to hedge a transaction, you buy the AU dollar call, you buy from a bank. So the big advantage is just buying a straight out option, if I looked on a stock option, is that I get value when it goes up in value. Okay? Hedging, you benefit from that as well. So the buyer determines the exchange rate, which is the strike price. Okay? The put option just goes in the opposite direction. You got the right but not the obligation to sell. So if I'm an importer, I will be selling Australian dollars to buy the foreign currency. Okay, so I'm selling Aussie to buy euro, to buy yen, or to buy US dollars. Okay, so that's a right to sell Australian dollars / buy the foreign currency. Everything else is the same. Okay, the pricing method is exactly the same for both of them. Okay. It's used by an importer, buy from a bank, take advantage of favourable movements in Australian dollars. Okay, and you determine the strike price. The student's going to ask me, someone's going to ask me, how do you decide what strike price to use? Okay, you decide that on experience and on how much it costs. You can get the best deal, the best exchange rate, just going to cost you a lot of money. So they're risk rewards, and I mean, the best deals cost a lot. It's very hard to beat it. Okay? Okay, so these are the price determinants, and this is in that little model which I'll load up, which I put up onto DSO. Okay? So what I've done is, in the past I had a whole lot of models together, but now I've just broken them up into separate ones, so a bit easier for you to use. Okay? So, the spot rate is given. It changes all the time. Strike, I decide the strike. The interest rates are given. The time period I decide. The volatility, the market tells me the volatility. Okay? Everything there is fixed except for... Okay, everything is fixed except for the strike price. Okay? Okay, the spot is not fixed. I mean fixed, it means it's given. Someone else decides that. The market tells me it's spot. Right? The strike price I choose. Okay? Interest rates are what they are in both countries. You put the risk-free rates in. Maturity is how long I want to buy the option for. And the volatility, the market tells me this one. This one's the hardest one to know. So when I did give advice on these instruments, the company I work with had someone in one of the banks, right? It was actually my partner's girlfriend, right? She worked in one of the banks, and she would fax us the volatilities each day, okay? So we knew what to put in the formula, okay? So it's important that she kept the job, right? Okay. Anyway, you know, so, and then I think it became a bit standard that you can ring, you contact the bank and they'll tell you, right? Okay, so the premium is a percentage of the face value. So the model I have is the premium's a percentage of the Australian dollar. So it's Australian dollars 800,000. So if you have to buy US dollars, you have to convert it to spot to get the Australian dollars. And then you multiply it by the percentage and it works it out. If you read a whole lot of books, there's different ways of doing it. And obviously there are European or American, and most of them are American style. Okay, so I'll go to the model now. Okay, so that's the model there. So just give me a moment and I'll close this down. Okay. Okay, removable disk. See my 210 version there. It's the 2011, there we go. Okay, so there we are. So when you put it up on your screen, that's what it looks like. Okay, so we've been doing some experimentation. I've got this scenario here. Okay, there's a problem with this scenario. One of the characteristics is just the price is not adjusting correctly. So don't worry about the scenario. Okay, you can ignore it. Okay, so what I do here is I can decide whether it's a call or a put. The model's set up so it's Australian dollar slash, it's Australian dollar first. Australian dollar's 1, it's indirect quote. It's all set up as indirect quote. Okay, so Australian dollar's 1. So I want to do a call option. Okay, the spot rate at the moment is 260. Okay, that's what it was at 5:30. Okay, the foreign interest rate. Okay, all right. So look at the model now. It's got the price of the call and the put, and the price is exactly the same, isn't it? 2.4321%. Anyone tell me why the price is the same?
Because there's no interest rate differential.
Good. It's no interest rate differential. So this is my test. When we wrote this model, right, we had to, I can get you the article if you want to read it, which has got all the formulas in it, okay? We had to just get this formula right, and last year we made a mistake. We had a plus B instead of a minus B in the formula, right? So it's right now, okay? So the thing is, to test whether it's right, is I put in all the things the same, it should come to 0. Okay, if it doesn't, there's a skew. Okay, so this tells me it's right. Now, so it's because those interest rates are the same. So you can see, it includes, so you can see how it's a derivative of the forward, because the forward includes the spot. See the spot, right? That's a forward. That's in the forward. The two interest rates, all that's okay within the forward, okay? And actually the time, okay? So the only difference is the strike and the volatility are the only difference. Otherwise, so you can see it's a forward. So they're all linked together. And a forward is really similar to a futures. So they're all related, okay? Otherwise you would arbitrage, okay? All right, so I'll switch down and we'll put in some the foreign interest rate. So put that in as 2.5. So I just put it in like that, okay? And Australian interest rates, risk-free rates 5.75, like that. The strike. Okay, so what I'm going to do here, it's a call option. So I'm an exporter, so I generally buy a call option above the spot. So it's 1.30. Okay, that's a bit high, that one. Okay, 03. Okay, 6. Okay, 0.33. That's part of a year, so it's a third of a year. So what's that? 120 days, perhaps about 120 days. So that time is in percentage of a year, okay? So not days, percentage of a year. And the volatility, I know generally is about 12%, okay? So as soon as I've changed those numbers, there's the formula. Okay, so the call costs 1.8797% of the Australian dollar value, okay? And that would be about what the market price. You go to a bank and that's about what the rate was. Now, to go back until early 1990s, customers didn't know anything about a pricing model. So the guy that taught me this stuff, worked in one of the banks here within Australia. He got headhunted from New York. He wasn't very old. Supposedly knew a lot about options. He really said he didn't, but anyway, the bank paid him a lot of money. And he would value an option at 1.8%. He would go to the companies and sell it to them for 5%. Company said, yeah, how do we know any difference? They'd pay 5%. He could tell you, I sold them to a BHP building for heaps of money we made off them because they wanted to buy options. They didn't know what was the pricing model. Nowadays, people keep asking the banks for more information. The banks get sick of it. The banks will give you the model, right? And you can price it yourself and it will be in that range because it's become more competitive, okay? So in this case, what's happening here is that this option I've bought at 1.036. So what I've done here is that the spot's 1.026 and I've bought an option at 1.036. So what I'm saying here is that what I've done in this case is I've bought protection. So for the length of this option, if I'm having to buy an option on currency which I have to buy in 120 days, 0.33 of a year, then I've fixed that the worst exchange rate is 1.036. Okay? So if the exchange rate goes up to 1.5005, okay, 1.0050, right, then I get to buy the currency at the lower rate. So you can see how I'm hedging my risk. What I'm saying is the spot rate's there now. I buy an option there, so if the spot rate goes up to there, I get to buy the money at the lower rate. Okay? I'll explain it doesn't quite as simple, but in understanding it, that's what it does. Okay? So if the exchange rate goes down, well, that's a better rate for me if I'm the exporter. So I let the option lapse and I get the lower rate. So the advantage of the option is that the exchange rate can go down, and that's to my advantage. If it goes up, I'm protected. Okay, now if you know a bit more about options, you think about a speculator wants the opposite to happen. A speculator wants it to keep going up because his option will be valuable. Right? I'll share my experience with you. Did I tell you about this one? My experience with an option? No? You got any Indonesian students here? No one from Indonesia? No? Anyone know who President Suharto is? You all know President Suharto? Yep. Okay. President Suharto was a president of Indonesia. Okay. 1997 it must have been. Okay, 1997. Just earlier that year, 3 of us bought a currency option. Okay, we did a direct speculation on the Australian dollar, US dollar. We paid about $15,000 for an option. Okay, which gave us the right to buy about $1.5 million if we wanted to. We didn't want the money, but you know. So our idea was that the Australian dollar was going to go up. Okay, Australian dollar did go up, and that $15,000 was $30,000. But then Suharto got the sack from Indonesia. The Indonesian economy struggled, and the Australian dollar plummeted. So our option ended up being worth nothing. Okay, so, but the reason is, and I gave the example to someone over the weekend here regards this, is that, you know, why would the Australian dollar drop when President Suharto from Indonesia got the sack? Okay, there must be a strong trading relationship with Indonesia. Well, there's not. We don't sell anything like to Indonesia like we do to Japan or China or Malaysia or India anyway. It's not very much that we trade with Indonesia. Can anyone suggest why the Australian dollar went down?
Sort of a regional bias that people think Australia's right next to Indonesia.
Yeah, 300 kilometres away. Gee, they're going to flog their currency like anything. They're in dire financial strife, political problems because of the domino effect from Indonesia. Not really, didn't happen.
The same thing happened in the Asian financial crisis, that South Korea didn't really have a terrible economy.
Yeah.
Because
yeah, but that, at least they did trade a lot with those countries, less so than what we did. But, you know, South Korea's made trade, I think, would probably be with the United States, you know, those manufactured goods. Yeah, Japan. So that's where ours, so they sold it. So anyway, in theory they did the wrong thing, but there we go. But you're right, my view was, you've got a trader in New York on Wall Street, he gets a map of the world out, there's Indonesia, draws a big circle around it, every country in that circle we sell. Australia's in the circle, we sell it. I mean, that's how smart they are, right? Okay, have you ever understand studying geography in the United States? Okay. They leave out Hawaii because it's not on the mainland, all right? They study geography. Okay. All right. So I can easily manipulate this, okay? And each thing I change, I can do that. So if I want to provide a better risk management, that is, I want to put this a little bit closer to the strike price, all right? So I make it 1.020. Okay. Okay, then the price, okay, goes down. Okay, so I'm accepting more risk. Okay, so if I put the price, so I changed the spot, didn't I? Gee whiz. Yeah, sorry. Thought it was a bit odd. 60. It's just I'm not used to dealing with Australian dollar when it's got a 1 in front of it. Okay? I mean, to be honest, I'm not, right? So that's one. So I move this one down, so it's 1.026. So it's exactly the same strike as the spot, which is called at the money, and the price goes up. See, from 1.87 to 2.27. So this is a better exchange rate for me if I'm the hedger, because I'm getting it lower, but it costs me more money. Okay? So I pay the premium to the other party. I'll show you later how you can avoid that, okay, legally. Okay? So the thing that influences everything the most is this volatility, which is the more difficult. So if I double the volatility to 22%, the price goes up quite a bit. Okay? So every one of these changes the price. Okay? Changing the price using the strike. Okay? The Greek letter they use for that is called delta. Okay? Changing the interest rate's called theta. Okay? And changing the volatility is called vega. Right? They're the Greek letters. Now, if you ever get the value of an option over 5%, I've never seen anyone trade an option for 5%. It's sort of viewed as too expensive. Okay, so rarely would that happen. Okay, so they could be lower. They'd usually be lower than that. It's so high because of volatility measure. Okay, So the other thing is, if I reduce the time period, is I make it 0.10. Okay, that's about nearly 30 months, 30 days. The price goes down. So you can see the shorter the time value, the lower the price. Okay, it's a fabulous model. Okay, because you adjust those things and the price will change instantaneously, and this is a reasonable approximation of the price in a marketplace. Okay, so disregard the scenario, and I'll put the call in here, but it automatically calculates the put option here for the same characteristics. Okay, all right, now I also posted up there a user manual, okay, which explains to, if you've been here tonight, you can see how to do it. So for next week, you need to download it onto your hard drive and just experiment. If you actually go through those problems in the user guide, you'll be quite familiar with it, because you need to manipulate it in your assignment, okay? Okay? And it's effectively a spreadsheet. Now, to give you an example, okay, this is based on, the formula is different, but the idea comes from a proprietary software. I had proprietary software from a company called Fenics, Fenics.com. Okay, it got an office in Singapore. And the guy developed Fenics. Okay, so if you get the proprietary software, this will calculate instantaneously the price of 30 or 40 options. And then you can do all sorts of variations, right? So I had this proprietary software, which they gave it to me for a year, okay? So what happened with that is that after the year, I couldn't use it anymore, okay? And I often used it to check that this model was working. But I found out that if I changed the date on the software, I could move the date back, it would still work, okay? It's good, yeah. I'm not a software engineer, but it was a smart... Anyway, I lent it to one of my former students. I haven't got it back, so anyway. So you can see that, okay? So I won't save it there. So there's also a manual that I put up with as well. And the manual actually uses the problems within the study guide. So it varies a little bit from the study guide, because the study guide has to be written in August, okay? And I like to change things after that, okay? So you need to become familiar with it. Okay, if you want more information about options, there's some excellent websites and other material. Okay, so I'm going to show you how to use them here. Okay, so these are, so you can put in the different variables and see what the change is. Okay, so what happens is that with options we use the term in the money and out of the money. Okay, so these are the types of diagrams I'm going to use. Okay, so what this diagram tells us, okay, is that that's really the spot price on that side. Okay, okay, so this is a strike. Okay, and here's the spot price. Okay, so I buy this call option. Okay, and over time the option goes up, crosses the strike, and it goes up to here, and it finishes there just about at the end of its life. That's called in the money. That means that this option actually has that value from there to there, is called its intrinsic value. So it has to have that value. So if I buy an option, an Australian dollar call with a strike of $1, and at the end of the time period the exchange rate's $1.10, then it has to have a value of the 10 cents. Okay, as its minimum value. Okay, that's why we use the term in the money. Out of the money is when it goes down below that call strike, and at the end of its life you let it lapse. Okay, now to throw it at you now, a very difficult thing to understand is that this looks like a good deal, doesn't it? Okay, but that's the worst case. This is the worst case exchange rate you get, less the cost of the option. Okay, because you exercise that option at that price and you get a better exchange rate than up here. That's what the option does for you. Now the best outcome for an exporter who buys a call is that the exchange rate goes down there somewhere, down to the floor. That's the best one. So when the exchange rate goes down to here, it's called out of the money. So if you were a hedger, what would you do here? Would you use the strike or would you go on the spot market? Go spot, okay? Because the best rate's going down, okay? This is the hedge, okay? So I know I've talked a little bit about speculation and so on, but essentially this course is about hedging the risk, okay? So this means that the worst case is what I call this, and I have to pay for it, okay? Next week I'll show you how you reduce the payment cost. So that's just some terminology. In the money we can exercise the call and buy the currency at a lower price and immediately sell it at the higher price. Okay? That means it's in the money. It's got value. Okay. Now the other value that takes place is the option here has, this is its value. This is its intrinsic value. Everything above that line's intrinsic value. But the option has a value when I buy it here, and that's just called time value. Okay, and that time value actually decreases. Can't show it on that diagram. But as I get closer, remember how the first thing I said when you buy the option is time? Time is valuable, right? Now what happens with time for an option is the time decays. When I buy the option, the time value of the option goes down like this. Okay? It's not linear. Okay? It goes down and then it goes down at a faster and faster rate. Okay? So, when traders sell options, they sell short options because they go down in value real fast. And I don't want people to exercise them. So that's why most don't get exercised, because they're sold. They go down fast. Because I think the market's going to do the opposite. I just have a view of the opposite. Yeah.
If there's not much time to maturity though, and they know probabilities suggest that you probably won't be in the money if there's only a few days or weeks.
Yeah, depending if it's a it's a 3-month one. Yeah, yeah. But there's a buyer there.
That's what I'm saying. So why is there always a buyer there if they know that the probability, the chances of the stake?
Well, I guess they have a different view. They think the market's going to go up. Okay, so I mean it's a large percentage don't get exercised. Okay, but yeah, they have another view. The view is that probability is that it will lapse, but maybe because even though it decreases in value really quickly, it's essentially still cheaper to buy than the option was. Say it's a 30-day option, it's still cheaper to buy than one was 20 days ago, and there's 10 days to go. So it loses most of its life in the last 1/3. Okay. So these weekly ones, you can sell them for a week. Well, they must just, if they've got 5 days, they just go like that. But people still trade them. Okay. So they're very good for structured strategies. They're stock ones, those. Okay. So that's trading markets. The currency ones are generally bought for hedging or straight out speculation. Yes?
You know how people who try to read the economy look at the yield curve for treasury bonds?
Yes.
Could you set up a sort of not a yield curve, but like a premium curve to look at options to then get a better...
Options on treasury bills?
No, options on currencies to get a better understanding of currency movements or the likelihood of future currency.
Yeah. The yield curve will just yield curve is just a time to maturity. So so that's generally always the yield curve is always positive because interest rates in the future are generally higher than generally like that all the time. Even though sometimes it goes like that.
Yeah.
Well, it'll give you some view what the market thinks is going to happen. Yeah, because the yield curve is effectively what the market's going to think happens to interest rates.
Yeah. But is that something that exists?
Well, you could, yeah. You could. You'd have to just sort of model it. I haven't heard of the idea, but as I said, Professor Corrado thinks it's just interest rates. He's published in the Journal of Finance, so he must know something.
Well, the yield curve on the options look different from the yield curve on treasury bonds.
Yeah.
You're trying to be wrong.
Yeah, yeah. Oh well, yeah. Market's the market. Okay. Market says what it says. Okay. Okay. All right. Any questions? Okay. So this is the opposite for a put. Okay. So in the money is down and out of the money up. I'll go over those again later. Okay. So that's just the explanation. So you can read through that. Okay. All right. The key thing is what happens at the expiry of the option, and you've got these opportunities. One, in the call option one, if the spot's greater than the exercise price, you strike. You exercise price will strike. Okay. You exercise. This also means it has intrinsic value, so you always exercise the option.
At the same time, do we consider the premium price? Do we consider the premium?
Yeah. Yeah. Sorry?
The premium plus the spike is less than.
You would all even your question, Keith, is that you pay a premium. Yes, you pay a premium, but you'd always exercise because you'll always get some money. Sorry? Well, I mean, let's go back to the call here. Okay. Let's say I paid a premium of $1. Okay. Okay. I paid $1. Now, at here, this has got to be worth something. Okay. No, you still exercise. Even if it's worth 50 cents, you'd exercise it.
Another thing is like...
No, hang on. If it costs $1 here, it might have been this intrinsic value at the end is only 50 cents. So I exercise it, and I earn 50 cents. That means I then $1 minus 50 cents is 50 cents. If I don't exercise it, I lose $1. So I'd always exercise it if it's in the money, no matter what you paid for it. No, the 50 cents doesn't include. That's just that's really the premium at the end. Yeah. That's how much it could be sold for at the end, 50 cents. So I bought it for $1. It's worth 50 cents now. I'll exercise and get the 50 cents and reduce the $1. Yeah. If I don't exercise it, I've lost $1. So I'd always exercise it. Okay, even for small amounts. Okay. Okay. So the value changes. Yes, your question.
I was just saying, premium is like a sunk cost.
Yeah.
Exercise your
Yep. Yep. They have to accept that it's a sunk cost. Yeah. But I'll show you how you can do it. You can get your money back. Okay. All right. Next week. Okay. 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 If a hedging one lapses, it means it's out of the money. Spot's less than the exercise price using the diagrams I gave you. It's got no intrinsic value. Okay. And at the end of its life, no time value. Therefore, we will let it lapse. Okay. So it's exactly the opposite for the current Australian dollar put option. Is exactly the opposite. Okay. All right, so to get it clear in your mind, right, because it is complex, I know that, okay, is that if you're an Australian exporter, okay, you buy the call option. That's how you hedge the risk. You buy the call to protect yourself from the Australian exchange rate going up. The best way to do it is to do some calculations. Do you want to receive more Australian dollars than less Australian dollars? Right? That's the question comes down if you're the exporter. Okay? At expiry, the Aussie dollar becomes a spot deal at the strike price if it's exercised. Okay. Or you can convert to an FEC. So it's more about that later on. There's a few different ways. Okay, so this just explains the intrinsic value. Okay? So what happens is, say the exchange rate is dollar for dollar. Okay? And I buy an option with a strike of $1. And it costs me 50 cents. Okay. And we go over it for 30 days. And at the end of 30 days, the spot rate's still $1. Okay. That option has gone from $1 to nothing. Okay? Because it has no intrinsic value and it's got no time value. It's worth nothing. Okay? It's gone from if everything stays exactly the same. Okay? So what happens here is that if I had have bought that option for $1 when the strike is $1, and at the end of its life the spot rate ended up at $1.10, then I have that 10 cents intrinsic value. I own that particular value. Okay? But I don't have any more time value because time's gone. Okay? Okay, so if I buy the call at 93, right? Spot's 90. Okay? 90 days. The premium's this amount. I use the price and I get 1.25%. Okay? So it costs me 1.25 of the AUD, right? On day 40 the spot's 94.20, day 90. So this is at the end of its life, the spot's 94.20. So I bought a call. Okay? What was the strike? 93. So I can buy the currency now at 93 when spot rate's 94.20. Okay. So what do I have? The value must be that minus that, which is 1.2 cents. Okay? And depending on the amount of currency they have, I can convert it to a percentage. Okay? Just need a calculator to do it. So it must be worth, if the strike's 93, spot's 94, it must be worth a minimum 1.2 cents. Okay? It's got no time value left in it. The day before, it would have been worth a little bit more if the spot was the same. Okay? Alright? So that just shows how the intrinsic value works with it. You can do it on the formula. Okay? You can use the model and change the time. Okay? Work out the price of it, and then you can convert. Okay? You can convert, put the time to 1 day. You'll see it. You know,
what is the formula behind that model?
Pardon?
What is the formula behind the model that you've got in the spreadsheet?
You want to see the formula? I have to give you the paper. Well, I mean, I can teach a whole class on options. Just take me 12 weeks. You know? I've got a whole lot of my colleagues are expert of the formula. Right? But what I try and do with this course is that, and it's worked well in the past, is that, you know, I've used the formula, right, and you can rely on that it's pretty reliable, right, except on black swan events, right. It has fat tails, it won't work, right, and you have to know that, right. But you'll learn how to use the model, okay. And what I'm going through today is there's a few subtleties there. It's good to know. You know, if you get 10% as a value, then there's something wrong. You know?
Is that Black Scholes you were talking about?
Yeah, no, the model for this one is called the Garman-Colhagen model, and all that is that the Black-Scholes model adjusted for currency. Yeah, and they, and it's only really been in the last 15 years that currency options become big. You know?
What is the base rate? Is it from the spot rate or from the strike rate?
Sorry?
How do you calculate the base rate? Is it the spot rate?
Okay, you use the spot rate on the day. Okay? People argue it should be the strike. It's a spot. So it's on the day. So whatever, if you're buying $1 million Australian dollars, it's just the value of the million. But if you're buying or selling $1 million US dollars, you've got to convert it at the spot, and then you multiply it by the formula. In fact, and a previous model used to do that, but it's simple anyway. I'll give you some examples of that. Okay? Okay, so this is what Wayne asked before. This is this time decay. Right? So if I buy the option now for $1 and everything stays the same for 30 days, the value of the option goes down like this. Okay, you can see there the value of the option goes down at a slow rate, and then eventually it goes down at a fast rate. So people who make money from selling options will sell them. Well, we've got to sell, but sell them here. You sell them knowing that they go and decrease in value very quickly. Okay, and the buyers, I guess, are not so sophisticated. But they're the stock ones. Okay, and the currency ones work the same. Okay. Okay, so this is, I'll just finish up. This is how it works. Where am I? Bit we'll do next week. Okay. All right. So We're using it in the currency context. So we have to say, the first thing you say to yourself is, what are we doing? Okay. Okay, I'm putting in all the context of an Australian exporter. This is where we are at the moment in Australia. Okay? So we want to hedge against the Australian dollar appreciating because we're an exporter. We buy an Aussie core US dollar put. Okay? So it's slash US dollar put. So it's a right to buy Aussie, at the same time sell the other currency. Okay? Strikes 92, spots 92.20, strikes 93. It's just above. It's what we call at the moment out of the money. Okay? Okay, why is it above? Because that's what firms do. Because it's cheaper. Okay? Maturity 60 days, premium's 1.6 of Aussie dollar face value. The face value is you're receiving 800,000 US dollars. The spot rate's 9220. Okay? And the price of the option's 1.6. Okay, so 1.6. That's easy to work out how much it costs, right? You know how much money you're going to receive in US dollars, okay? You've got 800,000 US dollars. There we are. Okay. Here's some more, right? We've got plenty. Right? Okay. So you've got 800,000, and you've got to pay your workers in Aussie dollars. So you've got 800,000, okay? So we convert it at the spot rate, 9220. So you're going to receive that in the future, right? That's a contract, sorry. That's a contract, not the money, the contract, okay? You're going to receive $800,000. Spot rate's 92, and you multiply the spot, today's spot, and then we multiply it by 0.0160. Okay, you pay me, right? You pay me on the bank, you pay me $13,000. Okay? So in 30 days' time, you've got the right to exchange this currency at 0.93. Okay. So that means if the currency goes up to 0.96, you would exchange it at 0.93 because you're a rational person, aren't you? Okay. You want to pay as low. You want to be able to convert these US dollars into as many Australian dollars as possible. Would that be your preferred? Yep. You like to do that? You'd rather more Australian dollars than less? Sure. Yeah, all right. What about you? Would you like more money or less?
I prefer to keep a lower risk.
Lower risk, but would you like more money or less money? More money, good. There's another rational way, right? So that means you will exercise the option, okay? Okay. And you'll get the lower exchange rate, which means you'll get more Australian dollars. So it's not hocus pocus. Okay, it's not what some people call smokes and mirrors. I've done this for accounting firms. I reckon it's smokes and mirrors. Okay, right. So the thing is that's what we do at the end of its life. Okay. So actually, we have to pay this in advance, though, but we may offset that cost too. Okay. All right. So this is what this on a diagram. This is what it looks like. That's that. Okay, the spot's 92, you can put it in there, okay? And that's the hedge risk 93.20. So if it goes up to here, I exercise and I get that rate, which gives me more Australian dollars. If the exchange rate goes down to here, I'll let that lapse, don't need it, and I go into the spot market and I get more Australian dollars, okay? Okay? So think of you as in natural student, just the opposite to what you're experiencing, okay? So many of you international students, Deakin University doesn't do any of this because you have to pay in Australian dollars. Right? You're managing the risk. Okay? Okay. So Deakin signed a contract once in Hong Kong dollars. They got in a bit of strife. Anyway, I won't go into that. Okay. That was before it was fixed. Okay. Oh, maybe it's a typo, is it? 3. Okay, yeah, it's 93. It's 9300, correct. Okay, so this number here just is a 0. Okay, just it's a typo by me. So that's a 0. Okay. Okay, look, I'll finish here. Right, so So that's putting a few things. It's also explained in the study guide as well. Okay, just using different problems. Okay. So I'm happy to take your questions on DSO. Okay. So you need to read that section of the study guide that's relevant to this. Got any questions, I'm prepared to take them. Okay. But some of the application of these tools quite common sense. The two students told me what to do. Right. You're always going to do the outcome that gives you the best exchange rate. And if you've got the option, it gives you the choice that it's going to move in your favour. And you can take advantage of that. Okay? All right, I'll see you next week.
Much better. I can put weight on it now. I can fit the shoe on now.
Okay, that's good. See ya. Okay, see you later. Good week.